Can you remember what we talked about in the last week? We talk about the elasticity concept, no? Right? Before that, we talk about the demand, supply, and the equilibrium. So, since we are looking at the consumers and the producers' behavior in the market environment, no? Right? So, we talk about the demand curve and the supply curve, and the interaction between the demand and supply. That talk about the equilibrium. So, as we identified in the last discussion, so the equilibrium analysis is a very important concept, no? Right? In economics, no? Right? And I highlighted another concept last week also. You may remember that marginal analysis, no? Right? Now here also we talk about the marginal concept as well. When we are going ahead with this demand supply and equilibrium analysis. Right? So now then we talk about the elasticity concept, no? Right? So you may remember that we identified a set of factors that determine the demand, no? Right? Consumer demand, no? Right? The demand for a particular product, no? Right? Depends on various factors, right? We identify the price of the other goods, complementary and the substitutes available in the market, no? Right? And income, no? Taste, and some other factors, no? Right? Common policies also, no? Taxation and the subsidies policies, no? Right? And the environmental changes. Now also we feel that the environment, the hot climate, the demand for a particular type of goods increase, no? Right? Soft drinks if you take, no? Right? No? Right? And people enjoy, that mean entertain more, that mean you know, environmental factors also they consider when they select some destination with the what we call this tourist, no? Right? Right? Likewise, the demand for that area also developed in that case. Okay. So the different factors we can identify that determine the demand. So based on those factors, now we need to know about the speed of change, right? So that's why we use the elasticity, right? How far these factors are responsible in determining the demand, right? What kind of sensitivity is there, right? That measures the elasticity, right? So based on three factors, no? Price of the whole goods and price of the related goods, no? Right? And the income. We identify the three concepts. Can you remember those three concepts that we identified in the elasticity? Yes. We identify the price elasticity, right? When the whole price of the product change, how it is going to be alter the demand of the product, right? Speed of change, right? Price elasticity and the income elasticity and the cost elasticity, right? So that we talk about the first price elasticity of demand. So that measures the responsiveness of demand due to change in the own price of the product, right? When other factors remaining constant. So that is the assumption we make. We assume all of the factors remaining constant when the price of the own product change, increase or decrease, how it is affecting the demand of the product that we consider, right? So that the magnitude of change, right? Speed of change given by the price elasticity coefficient, right? So that is the indicator that we use, right? So based on that indicator, we can say the nature of the demand exists between the price, and we explain the relationship between the price and the quantity. Right? So you can identify in the price elasticity, how we measure that one. We take the percentage change in quantity, and the percentage change in price, right? So we put the top percentage change in quantity divided by the percentage change in price. So we elaborate that one in equation form also, delta Q over delta P into P over Q. Based on that, you have given the relationship between the price and the quantity demand. So you can measure the price elasticity. And based on the indicator, the coefficient that you derive, so you can analyze the nature of the relationship between the price and the quantity demand. So there actually we identified certain concepts, right? So basically vary from the elastic and the inelastic, right? Elastic means if the sensitivity is very high, right? So the percentage change in demand is high with respect to change in the price, right? So that is elastic. And the other case is opposite case is inelastic. So there is no high sensitivity between the price and the quantity demand. So the percentage change in the demand is less responsive to change in the price of the one product. That is. So based on that, we identify two extreme areas that are elastic, inelastic, but other extreme cases also we identify something perfectly inelastic, no, right? And the perfectly inelastic. And other thing is unitary elastic at the middle point of the demand curve. We identify the unitary elastic demand, no, right? So there actually we noted the equal proportion. No? If the price change by 5%, quantity demand change also 5%. That is unitary elastic. No? Right? If you calculate the unitary elastic, price elasticity 5% will equals to 1. No? Right? If it is greater than 1 elastic, no? Right? If it is less than 1 inelastic. So if you look at the linear demand curve, right, so that we draw from left to right, no, downward sloping, we identified these 5%, no, right? It varied from point to point, right? At the intersection point of the quantity axis, no, right? Gives the perfectly inelastic demand, no, right? Perfectly inelastic demand, no, right? So that means the perfectly inelastic means prices not respond, no, right? Change in the quantity. Or did not respond, no, right? If the price increase or decrease, quantity demand does not change, no. That is one extreme point, no, right? So here, no, right? Perfectly elastic, inelastic, ceiling. To calculate the price elasticity of demand, no, right? Taking the different prices, but quantity demand does not change, no, right? You will reach the price elasticity coefficient ceiling. Other extreme cases, price elasticity of demand is elastic, but perfectly elastic. So that means without changing the price, demand can be changed, really, right? Even without changing price. So the price is fixed, but there are people can demand various quantities, right? So that kind of scenario, right? That is perfectly elastic demand. Right? That actually we see the once you calculate the without changing the price, if you assume certain quantities, no, at the same price, if you put the equation and calculate that one, you will get the infinity, right? So here, when it approaches zero, right, it becomes price elastic is infinity, right? It goes to the infinity, right? And in between that, we can identify this elastic, inelastic, and inelastic cases, right? So if it is less than one, no, right? If it is greater than one, no, if it is equals to zero, right? That is elastic and inelastic, right? Okay. So now in the linear demand curve, right? So this price elasticity coefficient varies from 0 to infinity, right? So this is our demand curve, right? So actually this later on we can discuss the implication of this, right? As the revenue of the term, right? This demand curve, right? Because revenue is the price of the quantity, right? Quantity is the demand, right? Demand by the price of the product, you get the total revenue. Here means price is the quantity. In that case, now this the relationship between the demand curve and the total revenue curve we can analyze, right? And also the marginal revenue something we can analyze, right? Using the marginal conception, so right, those things. Right? Now, if you look at the nature of the demand curve, right, based on these elasticities, right? So we see the perfect elastic case. Now it is we know that it goes to the infinity, right? So the nature of the demand curve is horizontal, right? Perfectly elastic, right? It becomes horizontal. Price is fixed, right? There can be various quantities, right? So that is perfectly elastic, right? Normally the perfectly competitive firm faces this kind of demand curve, right? Right? Perfectly elastic demand. Because now there are a lot of firms operate, and the consumers also there in the market, no, right? Very large number of we cannot count it even in a perfectly competitive market, no, right? So the single firm or the single consumer cannot influence the price, no, right? So in there is a competition, no, right? Because it depends on the demand and supply forces, market forces. No? Price is determined according to the market forces. So market determines the price, that means demand and supply forces, all together with all the consumers and the suppliers, no, right? Particular, if you take the particular consumer or the particular firm, they have no influence in the market. They cannot influence because they are very insignificant in the market, right? So their behavior is not actually will not have a significant impact in determining the price of the quantity, right? So therefore, the price is fixed based by the firm, right? The market determines that price is accepted by the firm. So based on that, they can decide to supply or not, right? So that means price is fixed, perfectly elastic demand in the firm. So this kind of demand for DC at the perfect competitive market. And the perfect inelastic means zero elasticity, right? So without working, right? So the price can be changed, but demand does not change, right? So that means perfectly inelastic. Those are the extreme cases, right? Normally the essential goods, right? No less, right? Stable goods, right? So once we acquire the necessary quantity, right? So there is no demand, right? For those kind of goods, right? Normally the perfectly elastic, right? And the unitary elastic, so that means the price elasticity coefficient equals to 1, right? Since there is an equal proportionate change in the price and the quantity. So what is the nature of the demand curve in the unitary elastic case? We identify rectangular hyperbola demand curve. What type of curve is that? Rectangular hyperbola. අපි කියන්නේ ඉන්ෆෝනස් ආකාර බහුවලයකින් වක්‍රයක්, right? Rectangular hyperbola. This kind of curve, right? So this is the rectangular hyperbola, right? If you multiply it by the price and the quantity, right? In any point, you get the same value, right? The product of price and the quantity. Any point of this curve equals to same value, right? If you say here is a price and the quantity is lower, no price and quantity, but the value is same, right? So in the rectangular hyperbola, right? So there's a, or if you take the consumer expenditure or the producer's revenue, no, right? Because we multiply price into quantity, right? So consumer's point of view, how much you pay, price into the quantity that you demand, right? And the producer's point of view, sorry, price into quantity, that is the total revenue, right? And that is the same, the consumer's expenditure, right? So there is no difference, right? It remains unchanged in any point of the demand, right? So that is the rectangular hyperbola. We have the unitary elastic demand. Normally we get rectangular hyperbola, right? So then the other one is the relatively elastic, right? So that means if we have the greater than 1, the price elastic coefficient if it is greater than 1, no, right? So that is elastic, right? Price is highly sensitive, right? So the relationship between the price and the quantity demand is very high, significant. That case, right? So that means the change in the quantity demand is higher than the effective price, right? So we get the elastic demand, right? So normally we get the flatter demand, right? So the flatter demand, right? So flatter demand explain the elastic demand, right? Price change, price increase, quantity demand increase significantly, right? In that case. So that's why we have the flatter demand. Other cases, if it is less than 1, that is inelastic, no, right? Price is not highly sensitive, no. So there is no big relationship, right? So when you talk about the price and the quantity demand, in that sense, there's an inelastic demand, right? So the nature of the demand curve is steeper demand. They were ready, right? So we have to take the price change. If the price increase in that case, right? Quantity demand decrease little bit, no, right? In elastic case, price is not highly sensitive. So if the price decrease, quantity demand, even though the price decrease, in that case, right? Quantity demand increase, not significantly, right? So it's very small value, right? So that's in that case we see the steeper demand, right? If there is a inelastic demand. So based on that, we can identify the slope of the demand curve change, no? Right? Normally we get the higher demand curve, there is elastic demand, deeper demand curve, there is a inelastic demand. That is very important, right? So in economics, we talk about the slope of the curves, no? Right? When we are making decisions, right? So that is very important. When you analyze the demand or the supply curves, right? Supply to other side, the price elasticity of supply, right? So in that case, here the price elasticity of demand, right? So that explains the slope of the curves as well, right? So that is very important when we are making decisions, no? Right? Even the pricing decisions, no? From point of view, right? So that is very important. Even government imposed taxes, no? Right? These things are very, very important. So the nature of the product, or the slope of the demand supply. Okay. So those are the five elasticities, right? So based on the you can identify the nature of the demand curve, right? Okay. Right. Now in the same thing, right? Perfectly elastic demand, right? Now normally perfectly elastic demand we see the homogeneous type production, right? So sugars, eggs, and food, right? So buyers will buy more they can at a given price, no? Right? So there is no limit, right? They can buy, no? Right? At a given price, no? Right? That's homogeneous type products, no? Right? And the perfectly inelastic demand is, right? So there is a price is not resulted in change in the quantity, no, right? Price can be varied, but quantity does not change in that sense, right? Perfectly elastic. So we have the vertical demand curve, no, right? So that actually, so we know that under such circumstances, if the price is increased, what happens? There is a perfect elastic demand. But when the price increase, quantity demand does not change, no, right? So that increase the revenue at the same percentage of increase in the price, right? So normally the drugs, no, right? So this habit forming goods, no, right? So we have the elastic demand, right? Okay, the rise in the price will increase the revenue of the product, right? Right. So these are the two places we identified that, right? So price elasticity of demand is elastic, but the elastic case and for the elastic case. So the two division operating specific, right? Okay. Right. So now if you look at the elasticity now here, this is normal demand here, right? So normally we gain the total revenue, right? Price into quantity, no, right? Is the price determined by the market, right? So the demand curve and the quantification. I'm going to put it like 5 found, right? So the price and the quantity, right? So the total revenue is given by and price 5, right? So the demand is quantity demand is 100, no, right? 5 into 100, that is 500. This area, no, if the total revenue. If there's a decline in the price from 1 to 3, what happens? Quantity demand increase up to 140, right? 140, right? So then what happens? 3 to 140 is greater than the price increase. What happens? It is there's a base. Over the right? 3 to 140 means something. 300, 420 something, right? So that is here. We have the elastic type of right? Demand curve, right? And the supply and demand curve, right? Right. So the total revenue we can measure, right? In case price on, right? We can analyze based on the elasticities. If there's elastic demand, and if there's elastic demand, how the total revenue going to be changed, right? Right. Okay. Right. So this is the elastic demand, right? Normally we have elastic demand, flatter demand, right? Flatter demand. So that means that there will be a price will be in the demand significant, since there is a high sensitivity between the price and the quantity, right? So in that case, what is the best option? By raising the prices or reducing the prices? What is the best? There is the elastic demand. So there is a high sensitivity. The price increase, quantity demand decrease significantly, that will reduce the revenue, right? If the price increase, right? If the price elasticity of demand is elastic, right? So in that sense, reduction in price will increase the quantities, right? Demanded in the market significantly, right? So that is the best option, right? If by looking at the nature of the product, if there is elastic demand, reduction in price is good, right? It's a good move to raise the revenue, right? Okay. Firm's point of view, right? If price is increased, all revenue decrease, in that case, right? So that's why normal goods, right? If the car prices increase, we know that what happened in the now automobile market, because of these restrictions, right? Car prices went up, right? Significantly, right? Demand also decreased, right? That sense, right? People are not buying cars these days, right? Right. We cannot import cars, right? And the prices will increase. So that will affect significantly for the demand, the cars, right? So that revenue also decrease as a result of that. Right. See the car will increase. So in the elastic case, increasing price is not advisable, right? Right? So if there's the firms produce product which has an elastic demand, reduction in price is advisable, right? So in order to raise the revenue, right? Based on other competitors' price and so on, right? Right. And the other case, now here you can see, right? So this is the nature of the demand curve. What is the demand curve? Is steeper, right? Or flatter. Yes. And the flatter demand curve, right? So if we take the quantities, right? So the different quantities, right? So the price is 10, right? So the quantity demand is 5, right? So the total revenue is how much? It's 50, right? And if it is, let's say, price reduce up to 7, right? So the quantity demand increase up to 20, right? So we take the price change and the quantity demand change, right? Quantity demand is significantly, right? So there is a reduction in price, right? And we have the standard demand, right? So that means the percentage change in the price is 30%, right? Right? Percentage change in demand is 300. How much is the price elasticity coefficient? How much is the price elasticity coefficient? So can you say this elastic or inelastic? Yes. So the following average percentage change in demand is 300 divided by percentage change in price. 300 divided by 30, right? Yes, right. We can take 10, right? That is the price elasticity coefficient. Straight that one. So that's elastic. right? There is elastic demand, right? If the price reduces from 7 to 8 to 7, right? Right? So the quantity demand increased by 5 to 8, right? That means the revenue increase, right? Right? This is the revenue, right? So 7 into 20 means 140. Earlier the revenue is 50, right? The total revenue is the increase of like this, right? And then the elastic case, right? So the price elasticity is usually 10. So non-revenue prices, if there is a decline in the prices, no? If we increase the price from 7 to 10, right? There will be a reduction in revenue, right? So that's why it's not advisable, no? If there is some elastic thing, right? Okay, is it clear? Right, it's a good move, no? Right? Reduction in price is a good move, right? Advisable, no? Right? If there is inelastic demand, right? So the quantity demand is less proportionate to change in the price, right? There's a less sensitivity, no? Right? So what happens if there is inelastic demand? What is the best option? Raising the price or decreasing the prices? What is the best option? Yes. What is the best option? If there is inelastic demand, raising the price. Because the price is not sensitive or highly sensitive to change in demand. Even though the price increase, demand is slightly, right? So that will increase the revenue, right? So that's why normally the government increase taxes for the goods which have a inelastic demand, right? The nature of cigarettes, right? So the time, there is the taxes. So taxes will increase the price, but quantity demand does not change, right? So those are the reform, right? People like it, but price goes with the time. And but the regular price, they will never give out the price. All the price, and therefore, right? Right? So therefore, the government can raise the revenue by imposing taxes. It can really has to be. That's why the time the budgets tax, right? Having for goods, right? This one. Inelastic. In that case, raising the price is good, no? In order to raise the revenue. Right. In inelastic case, we know that we have the steeper demand curve, right? We have the steeper demand. Even though the price A, right? Quantity demand does not change accordingly, right? So if you look at this one, right? So price 10 and the quantity demand is 5, 50 total revenue. There, if we reduce the price up to 5, right? What happens? Quantity demand slightly increase, no? Right? From 5 to 6, no? Right? So that means that will reduce the revenue, right? If you area the revenue price 5, right? 5 to 6, then earlier the revenue is 20 to 5, 50, no? That's the decline in the revenue. In this case, if there's a decline in the price, no? The price, which have inelasticity, right? So price change is let's say 50%, quantity demand change by 20%, no, right? 20 divided by 50, that means something 0.4, right? Inelastic, right? So inelastic demand and price coefficient is less than 1, right? So we see there is a reduction in revenue, right? So there is a decline in the price, right? In this case, we can say the price should there's increase in the price from 5 to 10, right? So that will raise the revenue, right? Reduction in price is not that advisable, right? So if there is a inelastic, right? So the raising price is advisable. In that case, it will be very good. Okay. Those are the two cases, right? So basically, we look at the elasticity, whether there is elastic or inelastic. So based on that, we can say that basically we can decide the prices, no, right? So in the first pricing decisions, right? So this is very important, right? So ratio of the product, right? Let's say elastic or inelastic, right? So the unitary elastic, right? So that is the rectangular hyperbola, no, right? The curve that we received, right? So that means the percentage change in price and the percentage change in quantity is same, no, right? So equal proportionate change is seen, no, like between the price and the quantity demand, no, right? In the case of unitary elastic, no, right? Here now, right? So and the increase or decrease in the price, what happened? In the rectangular hyperbola type curve, right? So if there is an increase in the price or the decrease in the price, the total revenue or the consumer expenditure will not change, right? Since the price in the quantity equal any point of the rectangular hyperbola curve, right? So you have to write downward sloping, right? But it's a rectangular, right? So that is the rectangular hyperbola curve, right? So in that case, if you calculate the price elasticity coefficient, it will equals to 1, no, right? In any point of the demand curve, right? When the price and the quantity is same, that imply the consumer expenditure or the producer's revenue not change, no, right? Along the demand curve. Even though the price increase or decrease, no, right? Consumer expenditure and also the producer's revenue will remain unchanged, no, right? Okay. So that is the special feature of this developers is there equal proportionate change, right? So elasticity, like how we take the summarize this, right? If the demand is price elastic, what happens? That means elastic demand, no, right? So that means there's a high percentage change in demand with respect to change in prices, no, right? So that means percentage change in quantity demand is greater than percentage change in price, no, right? Elastic case, no, right? So reduction in price would increase the revenue, right? So that will increase the revenue. Since the demand change is more powerful than the change in price, right? And the other case, inelastic case, right? Increasing the price would increase the revenue, right? Because the percentage change in quantity is less than the percentage in price, right? So percentage in quantity demand is less. You make less sensitivity between the demand and the price of the product, right? In that case, what happened? Reduction in price would reduce the total revenue. Increase in the price is that price, but in that case, if there is a inelastic tool. Okay. Right. Any question? Is it clear? Any questions? No question. Right. Okay. Right. So then what is the importance of this elasticity curve? So what is the personal and
Makes the relationship
yes. So how do you explain that? Okay, price elasticity concept is business pricing decision. So how do you explain that? There is elastic demand, what is the how the products can respond? If there is an elastic demand, how the product can respond by changing the price, right? You need to explain, right? Okay. So if there is an elastic demand, what happens? Reduction in price will increase the revenue, right? If the price is sensitive, right? If there is an elastic demand, increase in price, higher by the raise the revenue, right? So that means pricing decisions is very much important. We are taking the pricing decisions, right? We need to consider the price elasticity. And the second one, let us explain the importance of determining the what goes to tax, right? So government can decide, right? Because government budget, right? So every government will take of this. Or the tax cases, right? Coming some the fiscal policy, right? And the fiscal policy, right? So the budgetary policy is those are fiscal policy, right? Tax, revenue, and the expenditure policy, right? Basically, the expenditure also not about revenue policy, right? Tax, revenue received from the resources, but in the tax revenue, is not tax revenue, right? So the tax revenue is more significant, right? Compared with the non-tax revenue, right? Because the direct taxes, right? So in that case, in order to raise the government revenue, the government should tax the goods which have inelasticity. Demand is inelastic, right? So government can go raise the tax revenue for such goods. They raise the taxes on such goods, right? Because you increase the tax revenue, right? There is no doubt, right? If the demand is inelastic, the price is elastic, the is inelastic, right? So the government can impose taxes and goods. If you want to increase the revenue, to maximize the revenue. Right? So the government can use the price elasticity coefficient in raising the taxes. And the fiscal policy actions. Okay. So the third one, what is the third one? We then say something about how you feel. What is it? Now the government can impose taxes on the same thing that on the goods, right? If they are importing goods, no, right? What happens? If there is an elastic demand, now normally there is a tax, but the price increase, no, price increase. So the imported goods, no, right? Forcing some control inflation to the actual inflation controlling mechanism for right. So the government can impose taxes. So it has elastic demand because price increase. If there is elastic demand, quantity demand significantly increase of the rising. So that reduces what? The prices and the one circumstances. That reduce the demand pull inflation, right? You know that one cause of inflation is the demand pull, right? Cost push, yeah. It can be all that. Cost push inflation, demand pull inflation. When the aggregate demand increase, price is also increase, right? So if the government impose taxes on the goods which have elastic demand, right? Whatever the price increase, but quantity demand increase, that will reduce the aggregate demand significantly, right? If there is elastic demand, right? So that reduces the aggregate demand. That will control the inflation, demand pull inflation, right? Demand pull inflation. So, the unlimited inflation, we talked about in the macro point last at the last session, right? So these things, right? So demand pull and the cost push. Mainly the demand pull inflation, right? So that illuminati negative stuff, right? Because of the aggregate demand, right? When the demand increase over the supply, right? So that will push up the prices. The prices. So that's one solution is the government can impose tax on the goods which have elastic demand, right? That means that will reduce the demand significantly for such goods, right? Because after the tax price increase significantly in the market, market price increase, that will reduce the demand if there is elasticity. Right. Okay. Then next one. Now is it clear that can so government can use this concept of right as a control device on inflation, right? In the ground and help you look at the goods if they have elastic demand, if there was an access, right? If you control the prices. Okay. What is the next one? What is forex? Forex means what is forex? Foreign exchange. So for we say forex, right? Foreign exchange can be currency, right? Now the foreign exchange basically what is like? And we can consider the foreign exchange. Same way, elastic demand, right? Imported goods, right? Now when we are importing goods, we pay foreign exchange, right? When we are exporting goods, we earn foreign exchange. In order to save the foreign exchange, we need to control the inflation. Right? That means that we control the payment, right? Foreign exchange outflows. Import means foreign exchange outflows, right? We can control the outflows, right? We can save the foreign exchange. Save the foreign exchange. Right? So one thing is we can impose taxes, right? The goods which have elastic demand. Right? So we can improve the foreign exchange. Goods which have elastic demand, right? If there's the tax, the price increase. So that when the price of the goods increase, right? There is less demand, right? Demand. So that will reduce the import demand. The reduction in import demand, we can save the foreign exchange, right? So that's why as a foreign exchange stable, right? We want substitution industry license, right? The two strategies are there, right? One is export promotion, other one is import substitution industry license, right? Rather than importing the domestically produced, right? We establish substitution industries, right? Produce locally, so that we reduce the imports, right? That will save the quality. So likewise, same way, we can control and limit the import like we did last time, right? As a same second, right? So we ban the imports, right? 300, 400, right? So in order to protect the foreign exchange, we want to save the foreign. Same thing happens if we impose taxes, right? Elastic demand. And we raise the prices. As a result of that, there will be a lower demand for such goods that will come down so we can stay in foreign exchange. And influence the behavior of the firms, right? Overall, now we take the price elasticity, the elastic, inelastic, basically the behavior of the firms maximize revenue, right? So then we get the elasticity, right? They can make the pricing decision according to the price elasticity of the time, depending on the elastic or inelastic, right? So those are practical useful investment, basically pricing decisions, and also the government can use this concept, right, as a budgetary policy, and also government can use this policy to control the inflation and save the foreign exchange. And likewise, control the inflation. The fiscal policy action, right? Can be used, right? Without point of view, right? So then we will look at the determinants, right? So what are the determinants of price elasticity of demand? So what factors determine? So we identify price elasticity coefficient, weight, right? From 0 to infinity, according to that. Yeah, like the elastic demand, elastic demand. So why there is an elastic demand? Why there is an inelastic demand? What factors goes to determine elasticity? What factors goes to determine the sensitivity between the price and the quantity? That we here. What is the first factor? Availability of substitutes. Right? So substitutes available in the market. So that is a significant factor in determining the price elasticity of demand. Right? Why we say it's significant? So how do you feel that one? Substitute means similar products available in the market. If there are so many substitutes available in the market, but okay. There's a competitive market. So many substitutes are there. So there are substitutes. Consumer has no choice. So they can use instead of another product. So they can shift from one product, but with respect to change the price. Right? So that will have a significant impact on demand. Right? So the price change of one product, right? If there are substitutes available in the market, right? Because you can change their preference, right? So they can move from high price to lower price to because we have simple consumer, right? So we always try to maximize utility, something to given first state. I am getting that. So therefore, you always know the person have the lower price of that. So if there are substitutes available in the market, right, then we have a significant impact on the demand. Right? The price change. So that means demand is elastic. If there are more substitutes, demand becomes more elastic. If there are less substitutes, demand is inelastic because there is no choice. Right? No reference for the choice. Right? So that is one of the most important factors. Number of substitutes available in the market. Right? So if there are a lot of substitutes, demand is going to be more elastic. Otherwise, it's going to be right. And what is the next one? Right? Percentage of consumer budget. Right? Under city. So budget means how much you spend, right? From your pocket, right? That will have a significant impact, right? You spend large amount of a particular product. For example, if you take this poor, right? You spend large amount, right? You take something to go for a business or something, right? You are spending much. So from the opportunity, how much you allocate? Very important. Spend a large amount of income, right? As expenditure of a particular product, acquiring product, right? So when the price change of that product, what happens? And significant impact on the income. So if we have a large amount. So that means demand is elastic, right? So if we allocate less amount, right, that means it's not significant. If you compare with your revenue, right? Right. So there will be inelastic, right? So the percentage of consumers' budget, that means how much you spend, right? From your pocket, right? So you spend larger amount, right? So when the price change, that will have a significant impact on your pocket, right? So then the demand is changed significantly. That means demand is said to be elastic in that case. Otherwise, we spend small amount, even though the price increase, that will not have a significant impact on your pocket, on budget. So that demand is inelastic in that case. So that is the case, right? So how much you spend, right? And the time period. So what does it mean? Time period. Okay, this. What does it mean? Time is a significant factor. Of course, if we have price increase, right? That's right. Maybe now time period is short run or the long run, right? Immediate time, right? It can take very short run, right? And the short run, the long run, right? Immediately, when the price increase or connection occurs, it takes certain time for it to take effect, right? Period is short run in products, right? Even though the price increase very immediate effect, there will be no significant impact, right? Once time takes place, so right, we get the information of the other product, we check the demand. If it's short run or short run, one is elastic, but the time takes place, the demand is elastic, right? So the time period, that's also a factor, right? We adjust the price, right? And they are the impact on the demand, right? So demand is said to be more elastic when the time takes place, right? Because you will get more information on the market, right? Consumer has the information, right? That can be reviewed in the time period, exactly. So short term demand is inelastic, but short term. So the time period, that's also significant factor, right? Determining the price elasticity. So what is the next one? Good thing. Nature of the commodity. So what does it mean? Nature means we can identify different types of goods. So in such situations, right? With respect to change in the prices, right? What happened? Right? So for an example, luxury, for example, goods, right? So when the prices of such goods decrease, demand is that will increase higher. So that means for the luxury goods, comfort goods, demand is elastic, right? Sometimes the price is an exceptional case, so luxury goods, the price increase, demand also increase. That's the case, right? So, but normally if we take there's declining price of this goods, so there will be high demand, but also, so demand is elastic. And the other one is essential goods, that's elastic, right? This is subject to variation, right? So we cannot keep those goods for a long time, we cannot keep it, not like essential goods, right? Once the essential requirement will be right, even though price change, demand will be changing, right? So that means the price has right? So that is the rate of full, right? Normally the case of essential goods, so the essential is right. Price elasticity of demand is less than one, right? Changing such goods prices will have a significant impact on the demand for such goods. No? So that is another factor. Okay. Nature of the commodity. Right. Now, how many factors we identify? 4 factors we identify. Right. And the durability. Right. Durable products. What are the durable products? You purchase now, right? And you use it for a longer period. Right. So those are the durable products. Right. So, motorbikes, machines, no, right? Refrigerators, no, TVs, no, right? Normally, right? So that means the price elasticity of demand for the durable products, what happens? Price elasticity of demand for the durable goods will be more than 1. So that means elastic demand for the durable products. Right? So why? Right? So even though the price change, right? Demand will not. Now, if the price increase for such goods, right? Demand will decrease significantly. Right? So that means price elasticity of demand is Yeah. But if the durability is not there, what happens? Some goods are subject to pay, right? So for an example, if you take the vegetables, fish, right? Those we cannot keep it for a long time, right? So such goods are subject to the perishable life. So that means one is it has right? Sections, right? Cannot store the time period, right? The demand is said to be inelastic, no, right? Demand is said to be inelastic, right? For such things, right? So that is the durability, right? So we can identify different factors, no, right? So that determine the price elasticity of demand, no, right? So one important factor is the substitutes available in the market, no? Similar products available in the market, right? And how much you spend from your income, right? Right. And the other one is the time period, right? And the nature of the product, and also the durability of the products, right? So those are the factors that determine the price elasticity of. So keep in your mind these factors, right? So since depending on those factors, right, price elasticity can be varied, product, right? Okay. Okay. Right. Then we are moving to the cross elasticity. Right. Earlier we gave the price elasticity where we consider the change in the whole price of the product. In the cross elasticity, we consider prices of other products. Right. So those are the substitutes and the complementary. Right. Then the price of substitutes change, how it affects the demand of the product. That we consider how it is sensitive and kind of relationship. In the price of complementary goods came, right? How it is actually with the demand. Right? Here, the changing, we are taking the responsiveness of the demand or how we do the change. Price of related substitutes of the complementary. Right? When the substitute price change, how it is affected the fact that we can see. For example, when the Pepsi Cola price change, how it is affected the Coca-Cola demand. Cost price in the last week. Right? Other thing is when the higher prices change, how it is affected the tube demand. Like price. We take the price of the related good change, how it is affected the demand. Responsive of demand, you change the price of the related goods. Or we can say responsiveness of demand, you change in the now. For example, responsiveness of demand for the product X, you change in the price of the product Y. X and Y, right? So how we calculate that one? Over here, it says the quantity demand for the product X, right? The function of price of substitutes and the price of complement, right? So this is the price, X demand, Y prices, right? When Y prices change, how it is affected the X demand, right? So that is the cost price elasticity, right? Although when the Coca-Cola price change, how it is affecting the Pepsi Cola sales, right? Okay, it's Cola demand, right? That is the cost price elasticity. How we calculate percentage change in demand for good X, right? We take the demand for product X, we will change in the price of the product Y, right? So we divide the percentage change in demand for good X divided by the percentage change in price of good Y, right? So that is the cost price elasticity, right? Percentage price elasticity. Percentage change in demand yes, divided by percentage change in price of product Y, right? So how we take the percentage change in demand? Take the percentage demand for X, divided by for yes, divided by the percentage change in price divided by how divided by price of product, right? Here is the one delta Q X over delta Y into delta Q over delta Vy over Qx. Okay. Okay. That is the cost elasticity, right? Cost price elasticity. To change the percentage change in quantity demand for X, we will change in the price of Y, right? Percentage change in and we change in the Pepsi Cola prices, right? We take the change in the Coca-Cola demand divided by the change in the Pepsi Cola prices, right? Into earlier price of the Pepsi Cola divided by the demand of the Coca-Cola, right? And we take the to the X, P, Y, right? Price change and the change in demand, right? Our quantity demand change, right? For the Coca-Cola, right? If they outstanding the price of the Pepsi Cola, take the right? When the Pepsi Cola price increase 125, Coca-Cola demand increase 1,000. Likewise, right? So if you calculate now, these are the quantity demand, responsive of the quantity demand of the product X, you will change in the price of the product Y, right? To calculate the cross elasticity, right? So how you can calculate? We assume price quantity price increase or decrease, no, right? We assume price increase, right? So change in quantity demand for the this is the Coca-Cola. Pepsi Cola price, right? And the Coca-Cola demand, right? So change in demand for X, so that will minus 200, no, right? Because price increase from 100 to 125. When the Pepsi Cola price increase from 100 to 125, Coca-Cola demand also increase, no, right? Right. From 1000 to 1200. So the minus, no, right? Taking price is minus 25. Right? So we assume price increase from 100 to 125. Right? That is our assumption, right? So earlier price, that means Pepsi Cola price is 100. And the earlier Coca-Cola demand is 1000. Right? You can calculate the cross price elasticity of that. How much? Silent. 0.8, no, right? right? It's positive, you know, right? Because minus to minus cancel out. It's positive, right? So that is true, no, right? Because when the price of the Pepsi Cola increase, Coca-Cola demand also increase. There's a positive relationship. So these two goods are substitutes, right? So the substitutes goods, right? If you calculate the cross price elasticity, you get positive, right? For the substitute. If it is a complementary, once you calculate the cross price elasticity, coefficient should be negative, right? Since there is a negative relationship between the price of the complementary goods and the demand for the product, that because if you take the tire tube prices and the tire demand, right? So there is a negative relationship. So that also obvious here, no, right? Right. So once you calculate the cost price elasticity become negative for the complementary. So by looking at the cost price elasticity, you know, right? Positive or negative, you can explain the nature of the product, whether it's substitute or the complementary, no, right? So if it is positive, so two goods that we consider is substitutes, no, right? Those are the substitutes in the market. And the other thing is the coefficient. Here 0.8, no, if you get more value, no, right? Now here is the lower value, no, right? 0.8. If the value is 10 or 20 something, no, right? So cross price elastic, once you calculate the cross price elastic, if it is positive and higher value if we obtain, then that indicate another factor, right? So the number of substitutes available in the market or the competition in the market, right? If the cross price elasticity is high, that indicates high competition in the market because there are so many substitutes available in the market. That's why there is a competition. Right? It's a competitive market. We can say something about the competition also by looking at the cross price elasticity. Right? Okay, right. So this is the substitute, right? We can think about the complementary goods, no, right? Once you form the values here, right? For the complementary goods, when the price increase, demand should decrease, no, right? For the complement. Because you know that complementary goods are the goods that we jointly consume, no, in order to get the desired satisfaction, no, right? If the price of the, for an example, sugar price increase, tea demand decrease, right? Those minus sugar at the table, right? So there is a negative relationship, right? So the price of sugar is high, no, right? For the complementary goods, that kind of relationship is there. Once you calculate the gross price elasticity for the complementary goods, you get minus something, right? So by looking at the gross price elasticity, we can ascertain the nature of the product, right? If it is positive, that will the two goods that we consider substitute. If it is negative, the two goods that we consider is complementary. Okay. Right. So now the percentage change in the price of Coca-Cola influence the sales of Pepsi, right? It was price elasticity, right? So, for the substitutes and the complementary also we can take, right? Right. So why it is useful, right? Now we mentioned some points, right? Cross price elasticity is important in pricing decisions, right? So we can use this on pricing decisions as well, right? If the sales firms produce multiple products, right? So they can decide the price because sometimes those products may be the substitutes or the complementary, right? So when they are making pricing, so if there are similar other products they are produced, right? So they can consider how it affects to their demand also for the other product as well, right? So then when they are making the pricing decision, if there is multiple products, right? So multiple plants, right? Products. So using the instances for the pricing decisions. And also to assess the degree of competition by looking at this coefficient, right? So we can assess the competition available in the market. If it is high value, right? So that indicates more substitutes available in the market. So that means it's a competitive market, right? So those are the usefulness of the price, cost price elasticity. Okay. So is it clear? We need any questions? Right. Price is 6.8. Now we assume price increase from 100 to minus 3. Here data be one. Because 100 minus 125. So 100 minus 125 minus 3. Because we assume price increase from 100 to 100. Then how you take the delta T by change in price? Change in price means 100 minus 100 minus 50. So same way, quantity demand also increase from 100 to 1000 to 1200. So delta QX means 1000 minus 1200. Minus 200. Right? That's very important, right? This minus sign. Because price elasticity must be very careful. So when you put the minus here, right? You need to correctly assume whether the price increase or decrease. Right? Based on that, this side you right? Because this time is very important because price elasticity. But in the price elasticity, always this become negative. So we can ignore it. Right? Since there is an inverse relationship between the price and the quantity. But in this case, we must be very careful the sign. So based on the sign, we are going to take a decision. We are going to explain the nature of the product, right? If it is positive, substitute, if it is negative, complement. Right. So then the other one is the last one is the income elasticity. Income elasticity. Now we take the price of the one product, price of the related goods. Then the last one is the income. How they consumer income. Right? That's also a significant factor, right? So we need to look at the speed of change in the quantity demand, right? The quantity demand. We will change in the income, right? So how we calculate the income elasticity? Percentage change in demand divided by the percentage change in consumer income, right? So that is the responsiveness of demand due to change in the consumer's income. It's given by income elasticity. So the sensitivity between the demand and the income of the consumers, right? So how far the quantity demand is respond due to change in the income of the consumers. That's also very important, right? So we need to ascertain the relationship between the consumer income and the demand for the product that we consider, right? So so how you calculate that one? Percentage change in demand divided by percentage change in income, right? That is income elasticity of demand, right? Percentage change in the Y divided by percentage change in percentage in demand, whether percentage change in Y. I need Y to the delta Q X divided by delta Y. Y Q of Y. Right. So delta Q means change in demand divided by change in income into previous income divided by the previous quantity. Right. So for an example, demand to take the income, right? The income is 1000, demand is 500, and the income increase up to 1500, and increase up to 400. Right. To calculate the elasticity of demand, elasticity of demand, right? So the data gives we assume income increase from 1,000 to 1,500, right? Change in demand is 500 minus 400, that is 100, right? Change in income is minus 500 into the income is 1,000. Earlier demand is 500. How much? Income elasticity. Point four, right? Minus, right? Minus, no, right? The income elasticity coefficient, that is the value that you obtain, no, right? It's minus 0.4. Right? It's now when the income increase from 1,000 to 1,500, demand for the product that we consider decrease, no? From 500 to 400, right? So that is inferior good, no, right? Inferior good, no, right? When the income level increase, people move away from the inferior good. Demand for the inferior goods decrease. There's a negative relationship, right? Income and the demand for the inferior goods, right? So here, this good is the inferior good, right? Since the income elasticity of demand is negative. Right. Now, it can be positive or negative, no, right? Once you ascertain the income elasticity coefficient, right? It can be positive or negative, right? Normally, positive means greater than 1, no, right? No, greater than 0, no, right? Negative means less than 0, no, right? Sometimes it can be varied from in between 0 and 1, no, right? Positive in between 0 and 1, right? Can be greater than 1, no? Circumstances. So based on that, right? Based on the some elasticity coefficient, the value, right? So we can identify the nature of the product, right? For an example, if the income elasticity of demand is less than 0, so that means less than 0 means negative, no? Right? Less than 0 means negative, right? It's inferior, right? Here actually less negative, but it's not less than 0, in between 0 and 1, right? So it's not the inferior goods, right? It should be a negative, right? Less than 0, right? And if it is greater than 0, that means the positive, right? If it is positive value, right? So normally we can say it's a normal good, right? Normal good. If it is greater than 1, if the value is greater than 1, right? Positive greater than 1 should be a luxury good, right? Normally, when the income increase, the demand for the luxury goods also increase, right? Very high amount, no, right? So high value, right? So it is the luxury goods, no? More than 1. If it is the income elasticity in between 0 and 1, greater than 0, less than 1, no, right? So greater than 0, less than 1, right? So in between 0 and 1 is staple goods or the essential goods, necessity goods, right? So it's a necessity goods, right? In between 0 and 1, right? We can see essential goods, right? So by looking at the income elasticity coefficient, so we can define the goods, right? So whether it's inferior goods, whether it's a normal goods, whether it's a luxury goods, or whether it's a essential goods or necessary goods, right? So that is very important, right? Okay, right? So that's how we so those are the three elasticity concept, right? Price elasticity, income elasticity, and then cost elasticity, right? So you must deal with these concepts, right? So just price elasticity of demand, income elasticity, cost elasticity, those are important in manipulation, right? And to conclude this session, right? Some of the things in last day we also discussed, right? Relating to this area, right? Now, so if you look at the common interventions, different ways and means, common intervention in the economy, because I uploaded alignment also, right? The morning, right? Look this, there are 16 students, so thank you. And 16 students, are there more? This is good. I don't know, I need things to be done. But it's also like there are the students. Online students are out there actually. Because of the 16 students, I agree, I do. That's fine. If there are the students doing job, we know that. So now based on the loss, it's like the four groups divided into four groups, right? Basic for the first degree. So we have given asking like the first second time. Sometimes having some information time. We have also no time, right? So I decided that first class in the daytime. Because we have the time. They the assignment person. And you have to make a percentage of the assignment. So therefore, the design is the first site, so it's uploaded to the LMS. It's a and people to last week, right? So now there should be a good lead, right? You can assign your within your group leader. Your students is responsible to submit the final document. Right? Only one submission, right? And you leader can submit. So we need to coordinate those activities, right? So we have right? It's like the last we do member and we start like that, right? And discuss it with your group, right? And then I do here on the server and the file ground, so like starting it as such. So now here something that we know the different ways and means of government interventions, right? So last time also we discussed, interventions of the government side, price controls, price, consumer price, and the taxation, right? And so like important, right? Now, the government can restrict the free operation of the market and prevent from reaching the equilibrium, right? So earlier we talked about the free markets, right? So the demand supply equilibrium analysis, we talk about the free market forces, demand and supply forces operate freely, right? But the operation of such market can be controlled by the government, right? For various reasons, right? So that's why we ask you why the government intervention in the free market environment, whether it's useful or not. You need to form your argument, right? Based on that. So there are different ways. One is, as we discussed, the price controls, right? Minimum order price, floor price, ceiling price, right? Minimum maximum prices, and the taxation. And also we see the transfers and the subsidies, right? It's consumer transfers, right? And the production subsidies, fertilizer subsidies, right? That's also intervention, right? Sometimes government declare the transfers to the low-income families, right? Now recently, right? And there is another promise, right? By the diplomacy, giving supplies, right? Likewise. So consumer subsidy, right? one-way flow, right? The government with the needy people, right? So likewise, you see the government interventions in the market. And sometimes the restrictions, no, right? And the regulations, no, right? Regulate the market, no, right? Legal restrictions, right? Environmental regulations, no, right? Imposed by the government. And sometimes the government direct intervene, right? In the commercial sector, no, right? So in the production, no, right? And avoiding some business ventures, no, right? Government established, no, right? That's also kind of intervention, no, right? The free market sector, right? So likewise, we can identify different interventions of the government, right? So whether these interventions are, now we analyze certain things, right? So you need to think about more on that, right? The rationality of these interventions, right? Pros and cons, right? Whether the private sector oriented the market is essential, or with the government interventions, if it is whether it is essential, right? Or some kind of all this certain which areas government intervention sometimes you highlighted, no, right? Likewise, you can discuss your issues of the government, right? By looking at economic objectives, government objectives, no, right? Likewise, no, right? So different ways approach you can use it, right? When you are explaining things, and you can take the practical examples, no, right? When you are explaining things, when you are defending your arguments and so on, right? So that is the assignment you have to do, right? Okay. Right. Now the equilibrium, right? So I'm not, we talk about equilibrium, right? How the tax and the impact on the equilibrium, right? So we talk about now, if there is a tax, what happens? So we know that supply is affected to the supply, right? Supply curve stick to the left, right? Price may increase, not right? So that will vary with the quantity supply, right? Likewise, right? And the fourth thing is this tax, how the tax burden is shared between the consumer and the producer, no, right? So if the government impose tax, 1 rupee tax, no, right? For 10 rupee tax, price increase, no, right? So, but if the tax burden at 10 rupees get divided between the consumer and producer. So that depends on the price elasticity of demand and supply. And the slope of this demand and supply, right? Sometimes no tax burden will pass to the consumer, right? Sometimes no tax burden will pass to the producer, right? So that equally share, right? It's really elastic. Right? You can draw the curves, right? And see, right? So how the tax burden share between the consumer and the producer. Right? For an example, right? So, if there is the this is the situation, right? If there is a we assume elastic demand, inelastic demand, right? You know the steeper demand, normal supply. Demand is elastic. Inelastic, no, steeper demand. So this is the equilibrium, right? So this is the equilibrium. Price and the quantity, right? So if there is a tax, what happens? Now the consumer expects some more inducement, no, right? From the you will supply the previous quantity. That means you will supply price increase, right? With the tax. So if you roll the supply curve to the left, right? After the tax, right? So that will increase the price, right? So this is price increase up to D1 and the quantity demand increase up to D1, right? After the tax, right? What happened? Our the tax burden, right? So that is called tax incidence. The burden. How it is get divided between the consumer and the producer. Normally, if there is a price in the price, that should be bear by the poor consumer, right? It has to be equal, right? So the rise in the price. So this portion bear by the consumer, right? But if there's a after the tax of the market, normally the market price is right? Rise in the price, when you compare with the equilibrium, no, that should be bear by the consumer. What is the portion bear by the producer? So we need to check that up. We need to get the quantity supplied, right? And touch the all previous supply bill and see the price. So this is the price that the consumer and the producer is willing to supply the quantity, right? After the tax, right? So this part. So that part is bear by the producer, right? So that is, so if here the case is the demand is inelastic, right? More tax burden will be shared by the consumer. Right. Okay. So if there is a elastic demand, you can draw the elastic demand, right? So then what happens? You can see the equilibrium, right? We have to think about it, right? So by doing this, right? So if there is a elasticity, right? Then the difference other way, like so more tax burden will be shared by the consumer, right? Sorry, uh, producer than the consumer, other way around, right? So draw the curves and see, right? So if there is a unitary elastic, how it is happening? Only the and like the demand curve, not the supply curve, right? So in that case, you see tax burden share between the consumer and the producer equal, right? So we can do it, right? So we have the different cases, right? Elastic, inelastic is the most important, right? So what is unitary elastic case you can see, right? How the tax burden share between the right? So after the tax, what happened, right? So the increase the price increase, quantity supply increase. So the tax burden will be shared between the consumer and the producer, right? So now there is a social welfare also, costing welfare, right? So they are now costing welfare means now this area. So those are the loss, right? Social cost of tax is same. No one is getting it, right? Welfare loss, right? So there is a welfare loss also, right? Earlier also we talked about the dead weight loss, right? The cost owing to import tariff, right? Last week. It's also loss of social welfare, right? So likewise we see impact of taxation, how is affecting equilibrium, right? So after the tax, basically important thing is how the tax burden is shared between the consumer and the producer. So that depends on the price elasticity demand and the supply. Right? You take the price elastic demand first, and you can think about the price elastic supply in the other case, right? So that depending on the supply curve, right? So that will change, and the tax burden share between the consumer and the producer. And wait, right? Now the tax incidence, right? So that is the incidence in the division of tax between the consumer and the producer, right? Or the tax burden share, right? So that depends on the price elasticity of demand and supply. Generally, both buyers and the sellers pay the tax. Sometimes it's equal sharing, right? So, sometimes the entire tax paid by the producer or the supplier, right? For consumer also, right? For an example, if there is a perfectly inelastic demand, right? So that means the demand does not change, right? Sorry, perfectly inelastic supply, right? So that means supply does not change. The entire tax burden is shared by the producer, right? Because its supply does not change, right? So we can draw the curves and see like how the tax burden is shared, right? Okay, I'm not going to talk about, right? So this is the perfectly inelastic demand curve, right? Buyer pays the uh, entire tax, right? If there is a perfectly elastic, inelastic, perfectly elastic, seller pays the entire tax. So if there is elastic demand, sorry, inelastic demand in this case, right? The buyer pays more, right? They are the same. If there is limited elastic, equally distributed, right? There's elastic demand, so the producer or the seller pays more tax and likewise. So, right? So you can take the like volume curves, right? All the tax burden is shared between the consumer and the producer. And also supply, perfectly inelastic supply. So what is the nature of the perfectly inelastic supply? Supply also we can take that way, right? Perfectly elastic, meter elastic supply, inelastic supply, elastic supply, right? So perfectly inelastic supply means perfectly inelastic supply. Supply is not responding, right? And the perfectly elastic supply and the unitary elastic means it goes to the origin, right? Supply unitary elastic, right? Supply curve unitary elastic means it goes to the origin, linear line. So unique point of the supply curve is the elasticity of supply. It's equals to 1. Right? And if it is the one is not steeper slope, then be steeper slope penalty. And then flatter slope. Right? Steeper slope means inelastic supply, flatter curve elastic supply. Right? So likewise, you can draw the curves and see how the tax burden is shared, right? In the these cases, right? If there is a perfectly inelastic supply, supplier pays entire tax, right? Perfectly inelastic because supply does not change, right? Inelastic supply, right? So that means steeper supply curve in this case. If you can draw the normal demand curve and see the equilibrium, right? Right? In the inelastic supply, seller pays more, right? And the unitary elastic going to the quantity, right? That we equally shared, right? In that case, also. And the elastic supply case, buyer pays more. Right? Like this. So likewise, we can identify how the tax burden is shared between the consumer. We can draw the curves and see, right? Okay. So in your free time, right? Just take easily decide by graphical representations, right? How the tax burden is shared between the. Okay. Right. So the breakdown tax is the import tax we discussed last week. Can you remember? Consumption effect, production effect, wage effect, right? Social effect, right? and income. Right? Lastly, we talked about this one also, right? If there is a tariff, right? The equality goes out, foreign supply goes perfectly elastic, right? No, right? There's a tax on that, right? It will shift upward, no, right? And how the what kind of impact is there, right? So we discussed last time. So we can go into it, right? Okay. Any questions on this? Also, the tax case, do this. That's the city on the next. Only distributed. Okay. Do you have any clarification really? Can test those things, right? With the background, the drawings, right? So how the tax will is here, right? Right. So with that, we will finish this. So if you have any question, you can ask, right? Any questions? You need to ask at least one or two questions. So now this actually now there will be a MCQ test, right? So at the mid of this course, right? I will let you know the. So MCQ, I think I put it in the lecture plan, right? So based on the now these very first topics will be covered, right, for the MCQ test, right? So even though it's small concepts, you must be familiar with those concepts, right? Because you will ask certain questions, right? So, you need to go do those homeworks, right? See how this tax burden and all these cases, right? Sometimes very important, right? If you answer in the MCQ test questions as well, right? So therefore, you must be familiar with those concepts and the graphical explanations and so on, right? Okay, right. So if there are no questions, we can move to the next topic, the today's topic, right? Yeah. So we continue with that, right? After the break, right? So we can take the break, right? After the break, we will do that one. So that is the theory behind this consumer and the producer's behavior, right? So we talk about the consumer behavior, right? Theory of consumer behavior, right? So you can take the break, right? So how many minutes? 10 minutes? Okay. For 15 minutes. For go the time. 10 minutes, okay? No? Okay, so we'll start after 10 minutes break, right? So we'll move to the next topic. Okay. How about your group? Did you all the members are there in the groups? Did you check your group? Are you familiar with the group? You need to talk with your group members, right? And organize the activities, right? Because we have only 2 weeks time, right? So meantime, when you are gather, right? You can ready for the presentation as well. Later on, we'll decide the presentation, right? Right. I don't know. Leader that representative is submitted. Anyway, you can be illustrated. So that's why I asked you. Right? So only the 16 members that would be submitted by the asked so we will. Can you send me your details? Oh, you can. But that is PDF, you cannot upload details. So we will, I will include your details in one group. So which group you prefer? See you. Send me your details, your index number, name, I will include them. You can message me. I have given the study. So you can tell me your index number right now. I can change the study. You can just send me a message. You can send me a message. I will. You know my number? Do you know my number? Note 7707 16415. 07 16415. Send me a text message or something. No, then I can. Alright, I will change it. You can work on the groups. No problem. I will edit the group list. DOC. Ah, you send a test message or I didn't receive. What is the number you see? No, no. Double zero three 415. 5 I got it. We'll make the changes. We can, yeah, we'll be enough. Okay, shall we start? Right. Okay, I start. Right. So we are going to talk about the new topic, right? methodology, even though this is not a new topic, right? Now, earlier we talked about the demand, supply, and equilibrium, right? Now we are going to talk about the theory behind the consumer behavior, right? How we understand the nature of the demand here, right? So there is an inverse relationship between the price and the quantity, right? So the demand curve is downward sloping from left to right. So why there is such a demand curve? Why there is the inverse relationship between the price and the quantity demand? So theory behind the demand, right? Consumer, explained by consumer behavior, right? So we are going to talk about why the demand curve is downward sloping, right? So we are going to derive the demand curve again here, right? Based on the theory, right? Theory of the consumer behavior. So basically, our traditional theory you heard utility theory, no, right? So that is the traditional theory that explains the consumer behavior. But later on, due to some weaknesses in the traditional utility theory, which is based on the cardinal approach, no, right? So we may remember the cardinal and the ordinal. Can you remember? Cardinal analysis and the ordinal analysis. What is the difference? Cardinal and the ordinal. Some of you have studied economics and you are you know, and it was studied in the advanced level, and the most of the power. Every difference between the mind and the ordinal. Anyone? Yes. Now the utility theory, right? That is the oldest theory, right? Which explains the consumer behavior, right? So why there is a inverse relationship between the price and the demand, or why the demand is down or slowing. We can explain based on the utility theory, right? Right. So that is before moving to that, right? So you must know the cardinal and the utility. What is utility? Yes. What is utility? So why you participate for the lectures? But you don't get the satisfaction. Okay? You have some satisfaction once you come to the lecture, right? You have something like you are satisfied, right? To reach your target, right? Final mark. You need something, the satisfaction, right? Right? Now, whether it's regardless of the physical or not, maybe the service is right? So this is the service. If you are satisfied with the lecture or you are participating. If you are not satisfied, sometimes you are participating. Right? Well, since you are getting the satisfaction of time, right? Participating, yes, you continue to engage in the lectures. So that is something you will give satisfaction, right? Right? Assuming Windows service. Then we talk about products. Products means the goods and service, not like good. And the Windows service. So people by consuming as a consumer, like we consume products, goods and service. So that is what you gain. What is the benefit that you will enjoy, right? By consuming the goods. It's the utility, right? Or the cardinal analysis means, or the utility theory is based on the cardinal, right? Utility theory. It's assumed the utility can be measured. The satisfaction can be measured, right? That is the assumption we make, right? So we assign the marshal, assign the money, and you back to measure the utility based on that. You can measure the utility. Now, by consuming 10 units, you are satisfied, right? By consuming 5 units, you are satisfied. So, likewise, yes, you can be measured. So, that is the cardinal approach. cardinal analysis means, so it is the utility theory is based on the cardinal analysis, right? So it assumes the utility can be measured. Ordinal means it rejects the measurability of the utility because the practical we know that we cannot measure it. In order to assess the utility, right? We cannot measure, right? And the ordinal analysis is assumed utility cannot be measured, right? So reject the measurability of the utility. Instead of that, the ordinal analysis is that preference, right? Utility can be now based on the preference. We can assess the utility based on your choice. The level of satisfaction that you derive, whether you get a higher level, lower level, maybe based on the consumer preference and choice. So we can assess the utility of time. So instead of measuring time, we can prove or we can rank the utility of time. So that means the ordinal, right? So the indifference curve analysis. Indifference curve analysis based on the ordinal approach. So that is the new development that they want, right? Showing the weak point of the ordinal analysis, right? Since it is the measurability and other assumptions, right? So there are other assumptions we will do here, right? Because consumers will be continuously confirmed, right? The market is not right, and it must be a open condition, right? Like where there are certain assumptions, right? Theory. But indifference curve analysis based on the ordinal analysis, instead of measuring the utility, we track the utility, right? Based on the track the satisfaction that you derive by pursuing those types, based on the level of satisfaction, right? So that's why high indifference curve will give higher satisfaction, right? Right. So low indifference curve will give lower satisfaction, like by we analyze the satisfaction derived by consumer goods, right? So that is the ordinal and the cardinal approach, right? Now in the consumer theory, so basically we look at these certain theories, right? One is the utility theory, right? And the other one is the indifference curve analysis in order to explain the consumer behavior, right? So in the utility theory, basically we look at that is based on the two laws. One is called the marginal law of marginal utility, right? Here, right? Diminishing marginal utility concept, right? And the law of equimarginal concept, right? In order to explain the situations, right? So equilibrium we analyze based on the equimarginal concepts, right? So now before moving to that, right? So that is something that you give the slides, right? So highlights, right? Basically, now the ordinal cardinal, right? And what we focus on is the here, right? And the consumer behavior, right? Now, before moving to the analysis, right? So these are the questions that we have, right? Now, once you have done the demand, supply, equilibrium analysis, right? And elasticity also, right? Now, after doing that, now we have some certain questions. Explaining the demand. Demand we observe like it's the upward sloping, right? So what's behind the consumer demand here, right? Why it's the upward sloping and so. So that is the one question, right? And how the consumers choose from among the various consumer goods, right? Now we have the different goods, no? We talk about the utility and we have the satisfaction and pressure of the consumer, right? You always like maximize utility, right? Something optimization problems we discuss, right? So when you increase power as the consumer, right? He has to select the good, right? Right. Which gives the maximum satisfaction, right? So how we select? What kind of decisions he made in order to select the goods? That which goods he consume, right? Depending on his income, right? Because he need to allocate the constraint is the income, right? Income is the constraint. You need to allocate this limited income among the different goods that we choose, no, right? Then come to the maximum satisfaction. Satisfaction, you believe, no, right? So how the consumer choose those goods, no, right? Depending on his income, in order to reach to the maximum satisfaction. That is another question, no, right? Selecting of goods, no, right? And what determines the value of the consumer goods, no, right? So now the quantities, no, right? And this has to be his income, right? Among the goods, right? And we need to consume certain goods, right? In order to reach the level of satisfaction, right? And how is made is limited income, right? Because we assume this all income is spent, right? Among the goods to reach the maximum. There is no savings, right? There is another assumption made, right? So what income spent on the goods in order to make the maximum satisfaction, right? So what kind of combinations, right? So from different goods, we take the two goods, no, right? For simplicity, right? And analysis. So, but it can include the bundle of two goods, right? One bundle, another bundle. There are different specifications, right? But so how do we select this one? The problem. All these things questions is answered by the theory. Theory that we are going to explain under the theory and the sphere analysis. We are going to explain all this. Okay. Right now, utility theory. So as we mentioned, is based on the cardinal utility, right? Cardinal utility means we assume utility can be measured, right? And the other one is the indifference curve analysis, right? So to avoid the weaknesses of this utility theory, based on the indifference curve analysis introduced by J.R. Hicks, right? So that is based on the ordinal utility, right? Instead of measuring utility, it assumes. So we can rank the utility, you know, right? Based on the preference or the choice of the consumer, right? And the satisfaction we derive, right? Accordingly, we can identify lower level, mid level, high level. So that is the case. So those are the two theories. Apart from that, there is another one, reveal preference theory, right? So that also another explanation, right? Explain the same continuation preference curve analysis, right? So incorporating this other times and so on, right? So it's a modificative approach, right? So when you're going to talk about that, only we talk about marginal utility and so then is the utility and the style. Now, it is assumed that the consumers need to maximize satisfaction. You agree, no? Right? Right? Always we seeks to maximize the satisfaction. So when we reach to the maximum point of satisfaction, that we identified as the consumer equilibrium. Right? Okay. So because now here also we talk about the equilibrium, right? At which point the consumer come to the equilibrium. So that is the point where the consumer maximizes utility, right? Right. So that we'll talk about here. We assume always consumer seeks to maximize satisfaction. So that means when he reaches to the maximum satisfaction, so we assume that the consumer is in equilibrium situation. And he spend his income in such a manner that he get the highest satisfaction, no, right? So we know that constraint, when we achieve this target, maximum satisfaction, constraint is the income, no? Limited income, scarcity, no? Right? So the consumer has to allocate this limited income among the various goods, right, in order to maximize the utility, right? So and he spend all his income, right, in order to reach the maximum satisfaction. Right? And he always try to maximize the satisfaction subject to the constraint, right? So that is we talk about something constraint maximization. Even the consumer or the producer, you know that. So when he reaches to his target, he has the constraint, no, right? On the consumer, the constraint is the income. And also the price also we can take as a constraint, because price is determined by the market. No? Consumer has no control over the price, right? Because depending on the price, his real income determined, no? Right? Right. So therefore, that is also another constraint, right? Income and the price. Those are the two constraints. Another case, when you talk about the theory of the firm, the other side, so we take constraint there also, no? Right? Producer. When the producer maximizes profit, he has certain constraint, right? So this is always we talk about constraint maximization, right? So there are some analytical tools also, right, in order to explain these things, right? So when the latter part, we will be able to discuss those tools also, right? In managerial economics or in business economics, if we are doing, right? How this constraint maximization, like how we can reach to this target by deciding, by selecting the appropriate bundle of goods, or by incorporating the relevant factors of production to producer's point of view, right? Likewise, subject to the constraint. So how we can reach to the maximum point that we discuss, right? Now, here in this case, we take income is the main constraint, and we need to remember the price also there as a constraint, right? Right. So now utility theory first, that is the first theory we are going to talk about, right? Utility theory, right? So, so what is utility? So that is, you know, that it is the satisfaction that you derived by consuming goods or service, right? So what is the satisfaction that you take by consuming goods? So that is the satisfaction or the happiness, right? You can say, right? Or the level of comfort, right? All these things explain the satisfaction, in other words, no, right? By consuming. That's it. Now we consume goods for the service, no, right? In order to be happy, no, right? In order to spend, or in order to be more comfort life, no, right? So that is the satisfaction that you derive by consuming goods or service. That is, in broad terms, you can say it's a utility, no, right? In economics, we use this utility concept, right? And the cardinal analysis, so that is the approach that we use in explaining the utility theory, right? So that is the oldest theory, right? So therefore, the utility theory is the oldest theory of demand in order to explain the concept. So this is based on the decreasing marginal utility, right? So by nature, right? So what happened? You consume product. In economics, we talk about this the law, right? It's called law of diminishing marginal utility. So utility theory is based on the diminishing marginal utility, right? That is called law of diminishing marginal utility. So when you consume goods and service or the product continuously, the extra satisfaction that you derive, by consuming extra unit always diminish, right? Is it true? It's applied to all goods or services, right? So if you consume continuously, right? You fed up, right? Finally, right? You will reject finally, right? So that means you come to the maximum level, right? Right. So that means if you ask to another cup of tea or something, having number of cup of teas, right? Then whatever, right? Sometimes you vomit, right? So that means you get the finally you reach to the maximum level, right? So beyond that level, you are not accepting, right? So because when you consume goods, total utility is something that will increase, right? But the marginal utility, that is extra satisfaction by consuming extra unit, always diminish, from the first cup of tea onwards, right? When you consume, right? If you ask, if you given the orange juice, right? At the first orange juice, you will get the satisfaction, right? The second, get certain satisfaction that we totally did it maximize. But when you go to the third, fourth, fifth, right? you fed up with orange juice, right? Finally, you reject it. So that means the marginal utility, that extra cup of or the orange juice gives you the lower level of satisfaction. Right? It continuously decreases, right? So that's as a human being, right? When you consume continuously, that will happen, right? So that is based on the diminishing marginal utility, right? So that means the extra satisfaction that you derive through goods, right? Always diminish, right? That is the concept, right? Here also we use the marginal, right? So as I mentioned, the marginal analysis, marginal utility. So that is another concept term we use to analyze the situation, right? So in economics, we use this marginal concept as well. Here we talk about the marginal utility, right? Now this cardinal utility, right? So it's actually if there are some criticisms, right? So practically it's not for an example, this measurability of the utility and other assumptions is criticized by the economics. Therefore, the alternative approach developed later on, like difference curve analysis, right? Right. Now the utility and the marginal utility, right? So the utility is the benefit or satisfaction consumer obtain from goods or service, no, right? So by consuming products, right? So that is the satisfaction, the benefits, right? Consumer obtain. So now we know that product has the capacity or the power to give us the utility, no, right? Right, goods and service, no, right? So those are the it as products, right? Which has the capacity to give the utility, no, satisfaction. So by consuming those products, we get the satisfaction, right? So that is the nature, right? So we assume that utility is there, right? So by consuming goods and service, right, you get the satisfaction, right? So that is the extra satisfaction given by the additional unit of goods is called marginal utility. So how we measure the marginal utility? That means marginal now the total utility and the marginal utility. TU, total utility of product X and the marginal utility of product X, no, right? MUX. TU means total utility, right? So when you consume total additions, no, total utility always accumulate, right? First orange juice, second orange juice, third, no. Total utility at each stage that you get the certain level of satisfaction, altogether that explains the total utility, no, right? It always increases, not right? It always increases since there is accumulation from the first cup of tea or from the first cup of orange juice, no, right? It's always accumulating. So total utility always increases. Marginal utility, so that is the extra satisfaction that you derive by consuming extra utility. So how we measure that? Delta into x divided by delta x, right? So that is the addition, no, right? Or change the total utility to change in the consumption by 1 unit, no, right? Additional unit of cup of tea or interest, no, right? How much kg total utility? Delta divided by delta x, right? So that is the marginal utility. It always diminishes, no, right? That's why we say diminishing marginal utility, right? So, so that actually you compare, right? Now the marginal utility is the extra satisfaction, right? So when you are buying decisions, what you do? There, as an external producer, you compare with the pain that you make. The satisfaction to be like whether you reach to the another, whether you buy another unit, right? Another cup of tea, right? Another orange juice. Depending on the marginal utility that you may have, and the price that you pay for the unit, no, one pump of it. So the equilibrium in the total utility clearly explained. MU marginal utility should be equal to the price. Price of the product X, that means the cup of tea or orange juice, cup of orange juice, price should equal to the marginal utility of orange juice. Increased by the 1 unit, no, right? How much will be gain addition? The total unit is equal by the marginal unit to compare to the price you pay. Okay? What happened? If the marginal unit is higher than the price of the product you pay, you get more satisfaction, no extra satisfaction. Therefore, you buy it, no, right? You demand, no, right? Right. So if it is less than the price, no, right? You will reject your buying decisions, no, right? As a rational, right? Again, given the Srilanka utility, උපයෝගිතාවක් තියෙනවද නැද්ද? Your mind calculate all these things, no, right? When you are making the buying decision. So that means the equilibrium point is when x equal Tx, no? That is the equilibrium point. Until the marginal utility equals the price of the product that you pay, right? Consumer to decide whether to buy or not, no, right? Right. So this is the condition, right? Okay. So you compare the price you pay for the product and the extra satisfaction that you derive, right? But the total utility is extra satisfaction, right? Whether you go for the another unit or not, whether you buy another unit or not, right? Right. So that is the marginal utility is very important, right? So in utility theory, so the equilibrium point can be x equal the price of the product x, right? So the decreasing marginal utility, right? There that the marginal utility declines with every extra unit, right? That means over the time, marginal utility is increased, right? So you total utility increase, marginal utility is decrease. That means the total utility is increased at the decreasing rate. That's why marginal utility always decrease, no, right? So if you go, we can go it, right? Later on. So the total utility increase at a decreasing rate. That's why marginal utility continuously decrease. So that's why this law is applied, diminishing marginal utility, right? So that explains the consumer behavior. Okay. So what are the assumptions? So we assume cardinal measurability, no, right? We assume the utility can be measured in money terms, right? Or we can measure so the satisfaction will be like by consuming the energy, so I use like that, right? So we can assume the utility can be measured, right? And other factors that determine the demand, right? So other factors are the income, pace, passions, those things remaining constant, no, right? So we assume other factors remaining constant. That is the assumption we make all the time, right? When we consider one thing, right? We assume other factors in constant, right? And units consumed must be identical, no, right? So you consume identical units, right? Right. And also we assume you consume in a reasonable size, right? You are not taking the gallon of something, right? You take only cup of tea, right? And you continuously increase the cup of tea, no, right? Likewise, no, sizable, right? Portion. If you take the whole at once, no, this will not apply, right? Right. So continuously, gradually, you increase the consumption in sizable size, right? So then you see the total increase at a decreasing rate, or the marginal utilities continues to decrease, right? And the consumer needs to maximize utility, right? Compare marginal utilities with the price, right? So at the maximum level, right? Another one or not, right? That depends on the marginal utility and the relative price. So the condition is marginal utility should be the price, right? So those are the basic assumption, measurability, and other assumptions, right? Consumer must be in a normal condition, right? So if he's a drunken person or something, no, right? So mentally disorder person or something, this will not apply, no, right? Right. It must be in a normal condition, right? So assumption, right? So when we consume goods, right? Continuously at a particular time, right? Particular time, continuously, right? This will apply. So the diminishing marginal utility, right? So we assume the utility can be measured, right? Okay, right. Now here you have given the table, right? So we assume the quantities that the consumer is going to consume, right? Starting from 0, 1 to 1, right? And the total utility is given, right? Total utility is given, right? So you have given the total utility. So when you consume the 0, there is no utility, no, right? At the first unit, you get 60 units, right? Utility, no, right? And the second, you get 100, the utility, no, likewise, it always increases, right? It always increases, right? Totality increase. But at a certain time, it comes to the maximum level, no, right? Total utility comes to the maximum level, right? So after certain time, after certain quantity, right? So total utility also tends to decrease, right? So continuously increase, come to the maximum point, then thereafter it decrease by nature, right? So that is the total utility, right? So always, if we add the extra units, right? It's not the unit wise, right? At each level, right? At each quantity when you consume, so the total utility is increased, right? And the marginal utility, how you obtain the marginal utility? Delta TU divided by delta X, or delta TU divided by delta Q. Right? Q is the quantity that you consume, right? So that is the marginal utility. Or in other words, if you later on you will study, right, to take the slope of this total utility curve, right, slope, you measure the slope, right, by using the differentiation, right? So calculus, right, differentiation, if you measure this slope of the curve, you will get the marginal utility, right? Slope of the curve explains marginal utility, right? Slope of the total utility curve gives us the marginal utility. In other words, delta TU over delta Q, that is the marginal utility. What is the delta TU? When you increase from first 0 to 1, changing quantity is 60. 60 divided by delta Q means 1, right? Delta Q means 1. 60 divided by 1 means 60. Right? Second says 60 to 100 means change in total quantity. Utility is 40. 40 divided by 1 to 2 means even is 1. Right? 40 divided by 1 means 40. Right? Likewise, all the time this difference is 1. Right? We have taken this difference on the value, right? Divided by 1. Right? So then you will get the marginal utility. 130 means 30 divided by 1, 30. Likewise, you can measure the marginal utility. So what happened? What we can also in this table. So now the consumer consume particular product continuously. It increases its consumption, right? Continuously. But you see here total utility is increasing, right? Total utility always accumulating. We come to the maximum level, sir. And the marginal utility extra satisfaction that you derive by consuming extra unit, what happened? At the first unit, marginal is high, right? But it continuously decreases, right? At a particular time, it comes to 0. Right? Marginal utility comes to 0. So that is the point where total utility is maximized, right? So that is the point where total utility is maximized. Right? Marginal utility comes to 0. If you assess thereafter what happened at 12 units or something, this total utility also tends to decrease, right? not 197, then maybe 195 or something, right? So then marginal utility becomes negative, right? After certain time, right? That's positive region and zero, then thereafter it becomes negative, right? So likewise, we can observe. Now in the positive region, we take into consider, right? Positive area, right? So there we observe marginal utility continuously decrease, no, right? So that's why now then the consumer is consuming the product continuously. We see the total utility increase continuously, or it increase continuously, but marginal utility continuously decrease, no, right? That's why we say it's diminishing marginal utility, no, right? So this clearly is applied, no, right? If you plot this table, right, the graph, right, you can see total utility. This is the total utility this side into, right? The quantity that we consume this side, right? This explains the marginal utility, right? You and the quantity, right? Okay. So what happens to total utility? When you consume first, second, third, fourth, like that, total utility increase, no, right? So it comes to the maximum level, and thereafter total utility tends to decrease, right? Even the total utility also decrease, no, right? So this is the feasible area, right? Positive area. But here we see total utility increase at a decreasing rate. So you measure this slope, right? Slope of these different points continuously decrease, no, right? And therefore we see marginal slope of this curve given by the marginal continuously decrease because total utility increase at a decreasing rate. When the total utility is maximized, right? In other words, right? What happens to the marginal utility? It's not zero, right? So that means delta is point, right? You know this here, right? So this is the TUX. This is the marginal utility which comes to at the top level, right? Marginal utility comes to zero, right? At this point, this is the marginal utility of x, right? So this point, if you x equals zero, right? Right? So this is the, if you take the slope of this curve, right? Zero, no? Right? So that means delta tu over delta x equals zero, right? At this point. Or if you differentiate this curve in terms of quantity, you get the zero, right? From this zero. In this area, delta tu over delta x, what happened? Greater than zero, right? Here, delta tu over delta x is less than zero, negative, not right? Not right. So now here this is positive. That's why we have the positive marginal utility. Here the zero at the top level, at the, when the total utility is maximized, marginal utility equals to zero. Thereafter, total utility is negative. That's why here marginal utility, negative marginal utility. So we take the rational consumer consume this area, right? Only we can gain positive marginal utility. So that is the range, right? Consumer decide why or not, and we say, right? So that is the case, right? So we can observe all these things when you look at this behavior based on the definition. Okay, is it clear? Right? So now you can see these points are very important actually, right? This is the total utility is maximized, and the total maximized marginal utility comes to zero. In the it's negative, right? Here marginal utility positive rate. So this is the marginal utility continuously decrease. So that is the law applied here, no? Diminishing marginal utility, right? Okay, right. Now we can think about the equilibrium. according to this utility theory, right? So we select buy or not, right? Depending on the compare marginal release and the payment that we make for the product. Since we take the extra release, right? How much we pay for the extra price of the product, right? Unit price with the extra payment that we made, right? So MU equal price. So that is the the equilibrium condition, right? So until marginal utility equal price, we will decide, right? Right. So that is the equilibrium point. Right? When the marginal equal price, right? If we assume price of the product is 20, right? In the previous case, right? Here the price of the product is 20, we assume, right? Now here marginal utility at the first unit 60, right? It's about the price, right? Second unit 40, that's also about the price. And the third unit we observe, that's also about the price. We assume the price is 20. Right? And when you come to the fourth unit, right? The marginal utility also 20 and the payment for the product unit price also 20. Marginal utility equals price at this point, right? So this is the equilibrium point, right? Right? If we take the point is there, right? When marginal utility equals price, right? So there unit, that is the equilibrium point. So if it is the equilibrium point, what is the consumer surplus? For this MU equal to P, all the combinations, right? So taken as the consumer surplus. If we add over 60, 40, 20, 30, until it's reached to the MU equal to P, right? So that is the is willing to pay, no? Right? Right. Because marginal utility is higher than the price. Give it by. So this is explain the total outlay, no? Right? Is prepared to pay, prepared to buy, right? The total is explained given 150 rupees. Right? But actually, if there is equilibrium, actually we pay the actual price, no? Right? We assume the price is 20, right? We buy 4 units, no? Right? So that the actual payment is 80, no? Right? 80 rupees. So then the consumer surplus is 150 minus 80. So that is the consumer surplus. 7, right? So that is the difference between the total outlay and the total utility and the total outlay, right? Actually, the payment, the actual payment, right? So the total utility is 150, right? So that is the benefit to the consumer. You can ascertain as the consumer surplus. So this 7, right? So then we can see here, right? So this is things until say here is the consumer surplus. Surplus is total utility is given by 60, 40, 30, 50, 150. So actual payment we made at this point because marginal utility equal price. So the 4 units into 20 per unit, right? So that we made. The difference is the consumer surplus. Okay, sit here. Right. So that is the condition we apply here. Marginal utility price. We explain the consumer. Whether he buy or not, depending on this condition. Right. Whether he demand or not. Right. If the price, the utility is higher than the price, he will buy. Right. If the price is higher than the utility, he will not buy. Right? So until the marginal equal price, he will decide to buy the product. Right? So then, so when we explain the equimarginal, right? So that is another law apply when we explain the consumer equilibrium, right? Because the consumer is buying different goods, right? He assumes 2 products he consumes, right? Or 2 bundle of goods, right? Right? So that actually, to explain the equilibrium, right? We use the equimarginal utility consumed. So that is called low equity margin. So that explains the margin analysis here, right? In order to explain the two goods of the market. It's like just right. So given his income level, right? Because he has income, no, right? So his allocate is limited income between the two products or the bundle of goods, no, right? That he consumes, right? We take the price of the products, right? And the income. Right? So income is the constraint, right? And how much he spent, right? So for the different goods, right? Bundle of goods in order to maximize the utility, right? So that is the point that we consider here, right? So the equimarginal utility explain the stated that the consumer will distribute his money income, right? So that is it, money income, right? Between the two products. Okay. So in such a manner to maximize the utility. So how we spend this limited income among the two products with the view to maximizing the utility. So that explains the marginal utility. Okay. So here we take we compare the marginal utilities and the prices of the product, right? That actually explains the utility derived from last we spend on each product. So that we marginal utility divided by the price of the product, right? So that should be equal. We have the two products. So that means the marginal utility of money expenditure should be equal, right? Should be the same, right? So the marginal utility of money spent, marginal utility divided by the price. So this is the marginal utility, marginal utility of a product A, right? Divided by the price of the product. That should be equal to the marginal utility of B divided by the price of the product B. Right? Marginal utility of money expenditure should be equal. So that is the equilibrium. Right? So, for an example, right? I will have given this table. Right? Now, the two conditions are there, right? What are the conditions? One is the marginal utility. We take the two products X and the price of the product X, right? Marginal utility of expenditure, right? Should be equal, should be same. Right? Marginal utility of Y divided by PY. Right? So this is the first condition, right? And the other one is your income, right? Here, allocate our limited income. We distribute limited income among the two products. So that means the price of X, quantity that you purchase from the product X should equal plus price of Y in the quantity of Y, right? Should equals to income. So the Y or M, M is the income, right? So that means your total income you allocate in such a manner among the two groups, right? To maximize the utility. So this is these two conditions should be satisfied, right? Okay. Is it clear? So under this, because we have products, so we can say instead of two products, two bundles of goods, right? So we take the average price and so on, right? Of the bundle, right? Like those we can take, right? For simplicity, as we put that, right? So the marginal utility of money expenditure, right? Should be equal, right? And the other one is the total income distributed among the two products. This is the expenditure for the product X. This is the expenditure for the product Y. That should equal to your income, right? Okay. So the price of X, quantity of X, no? That is the total expenditure that you allocate. for the product X. So your income. Total expenditure that you allocate for the product Y, your income. That's the total expenditure you get divided between the two products. Such a manner, right? So we need to find out this price list. We know that is determined by the market, no? Right? How much we consume, quantity, no? Combination of it that we need to decide. Right? That is the equilibrium point, no? Right? Now you have given the table, right? We have given unit consumed, right? And how much utility, right? Total utility from the goods made, right? So this is the utility, right? Total utility, right? From the goods made. Price of, assume the price of the product is to be 1 rupee, right? And the total utility of the goods B is given by the price of the product B is given 2 rupees, right? So now you have to refer these two conditions, right? So we need to calculate the marginal utilities, not right? And then you need to identify the marginal utility of money expenditure as well. Okay? And when you find out the equilibrium, those should be equal, right? So then what is the marginal utility of A? You can calculate by each quantity. Marginal utility is delta T divided by delta Q for X, not right? How much? The first thing, we can now take this difference 10 minus 18, right? So this is 18. So the difference is delta T is 8 divided by 1. Here the margin is 8, no, right? And the first unit we cannot count it, right? The difference now will take this. Right. So here, so change is the 8 divided by 1, 8. Then here, 24, right? Here the 2, right? And then here the 1, right? Okay? You can fill the table. What is the marginal unit here? 8. 4. 1. Right? MUB, marginal will be how much? 44 minus 20 divided by 1. That means 20, no? Right? And 62 minus 42, how much? 18, right? 78 minus 62, very. Okay, correct? Can do it. So then we can we need to calculate this, no? Marginal income, money expenditure, X. The price of the product, price of the product A is 1 rupee and the price of the product B is 2 rupees. So A divided by 1. Say, no, So MUB divided by 10. So then we need to max there. Now we need to estimate the income, right? How much is the income? Price of the product A is 1 rupee. Price of the product B is 4 rupee. And the income, let's say 10, right? The income is 10. Right? So then you need to identify the points which satisfy these two conditions. Right? So now first one is MUXP mark. Marginal limit of money expenditure equals this. Only one combination we can identify. Right? Right? 8, no, right? So that means 2 units of from the product A and the 4 units of product B, no, right? Whether it's feasible, how you check whether it's feasible? You have to go to the second condition and see, no, right? Because you need to allocate your total income among the two products. If there is a balance savings, that is not the equilibrium. Because you allocate your total income, you don't get the maximum satisfaction. That means we need to check the second condition. Whether it's feasible. So the price of the product A is 1 rupee. So that means 2 into 1, 2. And the price of the product B is 2 rupees, 4 into 2, 8. That will equals to 10. No? So get your total income. No, right? Right. So that is feasible, no? Right? Sometimes you get 2, 4, 3, no, right? When you assess this one, right? So first condition sometimes we satisfy the two combinations, different combination you will get, no, right? Here only luckily we get only one combination, right? Sometimes you may get 2 or 3 combinations, then you need to assess which one is more preferable, right? Right? Based on the second condition, because total expenditure should equals to total income, right? So what is the equilibrium point? We consume 2 units from product A and the 4 units from product B, right? Right. So that is the equilibrium point, right? At this price, no, right? At this price, when the price is 1 and the 2, right? So then you can think about if there is a change in the price, right? If the price increase, say price of the product A 2 and the 3, you know, right? Then you can again recalculate this one and see the equilibrium, right? And the quantity is this. Right? Based on that, you can draw the demand curve, different prices of different quantities. You will get downwards domain demand curve, right? As well. Right? That way, right? Now here we identify only the equilibrium. So the combination, right? So the from the product A and product B, right? Which maximize the utility of the consumer, no, right? Okay, is it clear? So if we are given the alternative things, right? So the textbooks maybe you can have, right? You can check all these things, right? So sometimes different combination you will get, right? So that's the best combination, right? Among the alternative, right? Taking into consideration these two conditions, right? So this you should be satisfied, right? At the equilibrium point, right? So those are the conditions, right? Will be the next, right? Okay. Right. So the 2 units from product A, 4 units from product B, right? Right. So any questions? Is it okay? Clear? Right. That's about the in theory, right, they actually take the equity approach and the equity, that means the diminishing marginal concept, right? So there we identify the condition, right? Marginal utility should be equals to the price, right? In order to find out the equilibrium point. And the equilibrium is the equimarginal law of equimarginal concept to explain the there are two products, right? How the equilibrium is determined, right? There are, in order to identify the equilibrium points, these two conditions should be satisfied. Right? So the marginal utility of money expenditure for different products should be equal, right? When x over dx should be equal to y over dy. There are a number of products if we went over the price. And the income should be expended spent in the two products fully, right? In order to find. So there we can identify the points. Even we can know the demand curve, right? To identify the change in prices and identify the different combinations, right? So you identify the price and the quantity relationship. If you plot the curve, right? You can do the demand curve. We have one point on the debate, right? For the particular product, if we take price of the product, right? So we can draw the demand curve for the product, particular product A or B, right? Right. We take the product A at price 1 would be 2 in expensive, right? You can assume the price increase up to how much you can assess, right? How to reach once, right? Based on that, you can draw the demand. Right. So then the other one is, other explanation is indifference curve analysis, no, right? As we mentioned, this is based on the ordinal utility because this cardinal utility approach is criticized, no, right? So this is not realistic, right? Because one thing is the measurability of the utility, no, right? It's not realistic, and most of the economists criticize that part. And the other thing is the assumptions that we made when we derive the utility theory, right? Those things are not realistic. So therefore, so the more advanced approach is highlighted, right? So as a result of that, J.R. Hicks introduced this ordinal utility approach, right? So that is that based on that, the difference is developed, right? So there actually we make the preference, right? As we mentioned, right? So instead of measuring the utility, right? So we rank the utility, right? For high or low, we need to rank that based on the preference or the choices. So there we can identify the level of satisfaction, right? Level of satisfaction. Right? So the indifference curve, right? And if there are set of indifference curve, that is called indifference map, no, right? So now we can see different indifference curves, right? Different combinations of goods that the consumers are going to buy and equal satisfaction given, right? So based on these references, right? Because there may be several references, choices, right? So that explain the indifference graph of the map, explain the scale of preferences, right? Of the consumer, right? Level of preferences, level of satisfaction. So that means there can be higher level of indifference curve, lower level of indifference curve in the indifference map, right? So that explain the scale of preferences. Right? Normally, higher indifference curve indicate higher level of satisfaction. Lower level of indifference curve explain lower level of satisfaction. Right? So that is the indifference curve, right? So the indifference curve actually explain the different bundle of goods. Right? For example, different combination of goods, right? That the consumer is willing to buy, right? So and that will gives us the equal level of satisfaction. Any point on the difference curve gives us the same level of It's compare to explain the different combinations of goods. And the consumer is willing to buy which gives us the same level of. So what are the features? What are the features of the indifference curve? Anyone wants to know? Indifference curve also downward sloping, right? Negatively sloping. That explains the different combination of goods and the consumer willing to buy. Same level of satisfaction. So what are the features? Underlying features? Anyone? Yes, you can see this slide. Yes, that is actually now indifference curve, right? Explain the different combinations, no, right? Here we include the two products, XO1, right? So these are the two products, or two bundle of goods, right? And the product two, then we explain the two bundle. So actually, explain the different combinations, right? Right. So like this, utility A, utility B, utility C. What is the important point here? That can explain the different relations, right? So at each point, utility A equals utility B equals utility C, right? Same level of satisfaction, right? So what are the features you see here? Downward sloping from left to right, right? It's downward sloping, right? So downward slope, right? Right, negatively slope, right? So this is negatively sloped, right? And it is convex to the origin, right? Convex to the origin, right? Okay. Correct. Convex to the origin. So this is the downward sloping, negatively sloped, right? So the slope of the indifference curve, right? So that is now the slope, how we measure? Delta x is delta y, right? That is the slope. Delta x over delta y. So that slope of the indifference curve explains the marginal rate of substitution. MRS, right? So that is called marginal rate of substitution. Slope of the indifference curve gives us the marginal rate of substitution. How you are going to substitute, right? When you increase the consumption of product X, you have sacrificed the consumption of product Y. Why? Because you need to maintain the same level of satisfaction, right? So in order to maintain the same level of satisfaction, right? When you increase the consumption of X, we need to sacrifice the consumption of Y. Right? So that is the slope. Negatively slope, right? The slope of the indifference curve, marginal rate of substitution, that is negatively sloped, right? Since the marginal rate of substitutions decrease, right? Even though you should increase the consumption of a particular product, you need to sacrifice on the other side, right? So it will be same level of satisfaction. Otherwise, you cannot maintain same level of satisfaction, no, right? So that's why it's negatively sloped, right? Because the slope gives us the marginal rate of substitution, which decrease, no, right? to look at the marginal rate of substitution in degrees. And that is the first one, right? Strikeward negatively slope, right? And the higher indifference curve explain higher level of satisfaction. Now in the indifference map, right? There can be a higher level of or lower level of indifference curve, right? One, right? Higher level of indifference curve explain higher combinations, which gives higher level of satisfaction, higher level of feeling. Lower level indifference curve gives the lower combinations. Where you want the junction, right? With the lower level of satisfaction. Always the rational consumer tries to go for a higher level of indifference curve, but the constraint is the income, no, right? So it is the higher level, so constraint is the income, and the price also affected, right? Right. So higher indifference curve represent higher level of satisfaction, and it cannot intersect. Do you think that can it be intersect each other? What is your idea? Can the indifference curve intersect? For an example, we take the indifference curve, right? This is IC1. This is IC2. Right? This is the common point. A. This B and C are the 2 points, right? Can it be intersect? Intersection means the common point. No, right? There cannot be common points. Common points. There cannot be common points. What happens if there is a common point that violate actually the basic conditions, right? Because now, for an example, now we take the A and C, right? Utility of A equals utility of C, no, right? Right. Utility equals utility of A. At the point of this point, the utility should be equals to the utility of C, point C, not right? Because it's same level of indifference curve. I see one, right? Again, this point lies along the IC1, right? Same level difference curve, same level of satisfaction. And the utility of A should equals to utility of B as well. It is also same level of difference curve along the IC2, right? IC2, right? So then rule A equal UC, UA equal UB, then you can argue UB should be equals to UC, no, right? Okay. If UA equal UC and also UA equal UB, then therefore we can say UB should be equals to UC. Can it be happen? This cannot be happen because UB is higher level of indifference curve than the UC, right? Because this is lower level of indifference point is higher. But UB is greater than UC. Because UC lies the lower level of indifference curve coming under the IC1. UB is given the higher level of satisfaction because it's above the IC1, IC2 is higher level. So these are two contradictory things. But therefore, there cannot be common points in the indifference curve. That means it cannot be intersect, no, right? You are playing the indifference curve, you are going in sections, that cannot be happen. So there cannot be intersect points. Okay. So there is the cannot intersect each other. Two indifference curves cannot intersect. Right? And the diminish along the indifference curve, right? Because the marginal rate of substitution is diminished, no, right? Since there is a substitution, right? When you increase the consumption of one product, you have to decrease the consumption of other product, right? Since the MRS is declines, right? So, diminish along the MRS is decline along the indifference, right? And the slope of the slope is given by MRS, right? So that is the slope of the indifference curve. That is the marginal rate of substitution. So one good can be substituted for another. So that is the substitution given by the two products, right? To increase or decrease one side, this side, right? Of the other side, right? Keep the same level of satisfaction. Maintain the constant utility along the indifference curve, right? Okay. So are you sleeping? Right? Okay, right. So there is. So those are the some features of the indifference curve, right? Okay. So remember those things. This downward sloping, negative slope, and convex to the origin, right? And intersection, there cannot be intersections, right? So higher level indifference curve minus higher level of satisfaction, and slope of the indifference curve is given by marginal rate of difference which declines along with the indifference curve, right? So those are the features, right? So then we cannot explain the indifference curve, right? They also they are going to explain the consumer behavior, no? Right? How the consumer behave, how the demand curve is downward slope, left to right. So when we explain that one, right here we use the one side only, right? We take the utility, no? Right? So instead of measurability of the utility, here we take the we rank the utility based on the indifference curve, right? We ascertain the prevalence of the consumer, no? Right? But when we explain the combinations, right? The equilibrium point, no? So should decide depends on the ability, the consumer's ability to pay, no? Right? So that means based on the income, right? So therefore, we want to explain that one. We need to incorporate budget line to our model, no? Right? So how the consumer pay his limited income in order to get the maximum satisfaction by consuming different points along the indifference curve, no? Right? So which points we maximize, no? At this point, maybe this point, maybe this point, or this point, no? Right? Right. So we know that each point gives the equal satisfaction, but which point is maximize the utility of the consumer? That depends on this ability to buy, right? That depends on the same car. Therefore, we need to incorporate the budget line to our model, right? So budget shows the possible commodity bundles, right? For the combination of goods X or Y that the consumer purchase at given prices. So based on his limited income, right? How much we spend on product X, how much we spend on product Y. And determined based on the budget line, based on our budget, right? So we assume we have the fixed money income, right? So if the money income is given, so we can measure the quantities that the consumer is willing to buy, right? At different prices. So that explains the budget line. Right? Here also we make certain assumptions, right? So we allocate this total income among the two products, right? First we take the two products or two bundles at X and Y, right? So the expenditure on product X, EX into X, right? EX is the price of the product X and the quantity, X is the quantity, that's which. So this is the expenditure on product X, the expenditure on product Y, EY into Y, that should equals I in the total income. Now we can express this equation in terms of y. To take the y to one side, product y, right? So you can rearrange this one, right? So this one you take this side. So then you divide by the py explanation, right? So 1 over py into is 1 over py minus px over py into x. Is it correct? This explanation was mathematics, especially mathematics, after the equation. Okay. So this is the equation for the budget line. Okay. So there is a intersection point, no? Right? 1 over py. And the minus px over py into x. Right? Multiply pursuing the product x. So this is the equation for the budget line. Okay. Is it okay? Right. So what is the slope of this curve? What is the slope of this curve? This is a linear line. Slope of this curve is given by px over py. Right? So that is, in other words, that is the price ratio, no, between the two products. Okay. So we take the price of x, price of the y. No. So of the budget line gives the price ratio between the two products. Right? Right. So that is the equation for the budget line, right? So we can express in terms of y or in terms of x, right? You can express either y or x, no problem, right? Here we take the y in terms of y, we explain y equal 1 over py minus price ratio into x, right? Now, now we can take the budget line, right? So you need to draw this. Are you drawing these things? You cannot see in the, I think the for the recordings, you cannot see the whiteboard, right? Can you see the whiteboard? Here you can see. This one here. Okay, right? Anyway, right? So you must be familiar with this, right? So now budget line. How do we draw the budget line? Because now we have the two products, X and Y, right? So we assume, right? Now we have now we can assume that our income is 50. Money income, fixed money income is 50. And the price of the product X is 10, and the price of the product Y is 5. Example, right? Now how do you draw the budget line based on that? We need to derive the extreme points, right? Here the X and Y, right? Now if we allocate our whole income, right, for the product X, the purchasing power, right? Our money income is 50, price of X is 10. So here the 5, right? We allocate whole income, right? So that means n divided by px 1 point px 2 points we take, right? So that will be close to 5. Right? And if you allocate whole income in the other product y, price is about y. Our income is 50. So then the n divided by py, that is 10, right? So if you combine these 2 points, right, can go the budget line, no? Right? So that is taking the two extreme points. So we know the linear budget line. So what is the slope of this curve? Slope of this curve. This is the delta x divided by delta y, right? That is the price ratio, right? Not the delta x, right? Delta. This means M over Px divided by over Py. Not right, slope, right? That means M over Px multiplied by Py over L. To cancel out L, Py over Px. Right? So that is the slope, no? Right? As we mentioned, that is the price ratio between two products, right? Is given by the slope of this budget line, right? Okay. So this gives the different combinations here also, right? So that the consumer is willing to spend, right? Between the two products based on the given prices, right? So this salary is limited income between the two products, right? Fully, right? Right. So that is the budget line. So we need to incorporate budget line into our model, right? In difference curve analysis, right? So then we can explain the behavior, right? Under the constraint income, no? How we have the utility that will given by the difference based on the indifference curve, right? Preferences, right? That the consumer reach to the higher level of or lower level of satisfaction based on the difference curve. And then will be reached subject to the given constraint income, right? That explained by the budget line, right? So if we incorporate this indifference curve and the budget line, we can explain the behavior of the consumer. Now, what are the shifting factors of this budget line? We know that this budget line is opposed to downward sloping left to right, not right. One factor is supposed to shift the budget line. One thing is if the N is changed, so that means N is common to both sides, right? Because we take the purchasing power, right? If money income increase, no, right? What happened? Earlier we assumed fixed money income. No, we know the budget line, we assumed fixed money income. But if the money income change, entire budget line shift to left or right. If the money income increase, no, right, from M0 to M1, money income increase from M0 to M1, right? This curve shift to the right. Because M1 over Px, M1 over Py, move the new budget line. Our purchasing power increase, budget line shift to the right, right? If money income increase from M0 to M1. That is shifting factor, no, right? Right. So one is the change in money income. And the other one is changing prices, right? What happened? Either price of the product X or price of the product Y change, right? What happened? If there is a change in the price of the product Y, what happened? Now the price of the product Y decrease Py1 to Py2, right? There is a decline in the price. Right? What happened? If there is a decline in the price of product Y, this curve rotate, right? From the y-axis, no, right? Because money income does not change, it remains M0. but there is a decline in the price, right? From 1 to 2, right? Because PY1 is higher than PY2, right? Because there's a decline in the price of product Y. So that means if there is a decline in the prices of product Y, at a given level of money income, consumer can buy more of that product, right? Purchasing power increase. Therefore, budget line rotate from that axis. Right? Here the rotation, not right? Rotation. Keeping the given one, right? Rotate from that axis, right? So that is also shifting, right? So due to the decline or the increase in the prices, no, right? Budget line, if there is a rise in the price, right? Budget line rotate downwards, no, right? From that axis. Here the budget line rotate upward from that axis. So there's a decline in the price, right? So that is the rotation, right? So those are the two factors, right? If the income is increased, the entire budget line shift to the right, right? If the income increase, that shift to the right. If the income decrease, shift to the left, no, right? If the price of the product change, right? So that will rotate the budget line from that axis. Shifting factors are so you will change with the price and you will change with the income. Okay. Is it clear? Right. Now you know the shifting, right? Now what is the equilibrium? Right. So the price we can also measure, right? Here price, if the price from the product is here to change the line and things like. If there is a decline in the price of product X, rotate of that axis, right? Fall in the price of price, fall in the price, prices, rotate the axis, right? Right. Expectation, right? Right, and it's clear, right? So now the equilibrium, right? Equilibrium established by taking these two, right? So the budget line now we have the indifference scale, right? Then my line. So this is the equilibrium point, intersection point. That is the utility maximizing point. This is the point where the consumer the equilibrium. Right? When the budget line tangent to the difference curve, right? So that means at this point the slope, two slopes are equal, no, right? Slope of the indifference curve, but what is it? Marginal rate of substitution, RS, equals to slope of the budget line, the price ratio by X, right, at this point. So that is the equilibrium point. For the utility maximization subject to the income, right? Constraint, right? So at the combination of the goods for which the point where the indifference curve just adjacent to the budget line, and it will be some utility given, right? So based on the indifference curve and budget line. So we know that and we derive the based on the utility theory, right? Marginal utility of money expenditure, right? You remember, right? So should be equal, right? Now there also we take the prices, right? This price ratio, right? So we can express this one mu x over px equal mu y over py. Mu x over mu y, px over py. Right? Same thing, right? Right. So that one also same, right? So that means that we can relate with that, right? Marginal utility of money expended is also equal at this point, where the tangent point of the independent is going to be the independent is going to be the budget lines, right? So that takes the utility maximization. So the consumer allocates is limited income, right? In order to maximize the utility, right? So that means marginal utility per piece spent on each good, right? So this is the marginal utility per piece spent on each good. Marginal utility per money expenditure for the products, At this point, the slope of the equivalence curve and the slope of the line also equals, and that means the price ratio, the marginal rate of substitution. All these points are equal. So that is the concept equilibrium. Okay. Now you can see here in the indifference map, right? So we have the different indifference curves, right? Different combinations, right? And the maximum is being reference, choice, right? But at a particular point, we found the equilibrium. So that is the tangent point of the budget line and the equivalence point. So this is the two x1, x2 combinations, right? So that is the equilibrium. Negation action. Any other point, nothing to the point. If we take the point here, right, is something compared with this is the lower point. This is like the lower indifference curve, right? But also it's along the budget line. But it's not a equilibrium point. Because it's a lower point compared to this. Even this point. And higher point consumer prefer, right? No. But depending on its income constraint, no, you cannot reach those points. Those points are not feasible points. Those points where the budget line and the indifference tangent, which we will that gives x1. This combination, right? It's going to be given budget line, right? And income, right? Fixed money. Okay, so that is equilibrium. Right. Now we can derive the demand curve, right? Am I going fast? Am I going fast? We need to talk, right? Yes. Any catch? No problem. Right. So now this is the, you need to remember those things, right? What we talk about the market planning, right? Finally, analyze the equilibrium, right? So yeah, tangent points. So all these things explained there, right? Right. Now it's very simple, right? So derive the demand based on this indifference curve analysis, right? Now we know that we have the equilibrium point, right? Where the difference curve and the budget line is 10, right? So now we take the here it's given the particular budget line, the price, right? At a particular price, income divided by price of particular x, right? Right. Now we have to draw these curves, right? So when you are at home, right? Or at your office, right? So we have to draw these curves and see, right? Must be familiar with these curves, right? Analysis, right? So when you explain the things without drawing graph, you cannot explain, right? So therefore, you need to incorporate graphical analysis for the explanations, right? Otherwise, it's partly completed, right? So now we take when we put the products, right? This is the magenta line and the reference curve, right? That's the one, right? Now, in the equilibrium fund, X1, Y1. Okay? Now we know that here the money income, the price of X, right? EXP. Here the money income is F0, PY0, right? Price of Y is PY0, PX0. Right? And we demand X and the Y quantities. X1, Y1 quantities. Right? So this is the equilibrium where MRS is 0, right? Marginal rate of substitution. There is a PX Y. These things. Marginal rate of substitution, right? So, if the price of the product, how we assume price of the product Y increase from the price of the Y1. Okay? So there is a decline in the price of the product Y. So that means take the bucket line back from that axis line. Here the money income is does not change. Price of the product Y decrease from PY0 to PY1, right? Decline in the price of the product Y. That will rotate the budget line because the consumer can consume. There's a possibility of consumer to consume more from the product Y. That will explain by rotating the budget line from that axis, Y axis. Right? Now with that, he will reach to higher level of satisfaction, no? Right? Because he can consume more from the product X. Leaving the product X constant or changing the product X as well. Right? So that will explain the higher level of indifference curve, right? IC2, right? Indifference curve shift to the right, because he will reach to the higher level of indifference curve because when we consume more from the product Y, we will reach to the higher level of satisfaction, right? So that will change the combination, right? Maybe, right? X2, Y2. Right. Now he consumed from X2 from product X, Y2 from product Y, and come to the maximum level of satisfaction. So we can assume there is a further change in the prices, no, right? If there is a price change further, right? Increase the Y2, right? Whatever. And that will make difference here further. Y2, right? Price decrease. That will go for higher level of different I see 3. Will consume by 3, right? Name, right? By 3, like no different combination. So So that is the situation, right? This is the high level of satisfaction. These are the high level. Still, right? Equilibrium moves from V0 to V1 to V2, right? Likewise. No? So here now, this as is explained by combining these equilibrium points, right? That will explain the other things, right? So that is called price consumption curve. This is right, price consumption curve. So by combining the equilibrium points, right, with respect to changing the prices of the particular product, right, we can do the price consumption curve. Right? Now here, what you can see, you can take the combinations, right? Now we will draw the demand curve for the particular product, no? Right? Now we are going to draw the demand curve for the product Y. So the price of the product Y change from PY0, PY1, PY2, right? So the demand, how many demand? The product Y change, right? From the PY0, right? The quantities were Y1, right? So Y1 and the Y2, Y3. Price decrease, quantity demand always increase, no? Right? So we can take the price and the quantity demand, right? And you can draw the demand curve, no? Right? So demand curve, here the product Y, the demand for the product Y, right? So we take the PY0 in the higher level, no? Right? Y0, Y0, PY1, PY2, right? PY0, Y1 is the higher price, lower, Y2, right? Can hold the demand for the product Y, DY, right? Likewise, right? Taking those combinations, right? So we see the downward sloping demand, right? So that is the with respect to change in the prices. We can take changing price either Y or X, right? One side only, right? Because we take the demand curve for the particular product, right? So we will, right? So same thing explained here, right? So we assume the price change of goods too, right? Price decrease, right? So the quantity demand quantities increase from that side, right? So that's what the budget line on the two axis, right? And see the quantities demanded, right? When there's a decline in the price of the goods too, right? So taking the relevant prices, the quantities we can because we assume price will increase, demand will increase, and then so this is the V1 price, the quantities V2, V3, right? So budget line for A. So the relevant quantities X1, X2, X3, right? So based on that, we derive the right. Same thing explained here. We can put the values here, right? Then we can right. Here, right. So so you need to explain how the story behind this, right? Just graphing and from starting from the initial state, at the initial state is E0, right? So you can say something about the equilibrium, the conditions, right? At this point, at the tangent point, right? And the situation is price, particular price, right? If then we assume the price of the product to Y decrease, right? That equilibrium change, no, right? Like, so we can explain the things like from the equilibrium change, right? Then we can take the price of right, right. So based on that, we can derive the demand, right? Okay, right. So having the derive the demand, right? It's in clear. Story can develop your story, you know, right? So we want to explain this, right? So when you go to the different influences, demand curve, right? So how you derive the demand curve, you must be able to explain, right? Explain this, right? So we see the downward sloping demand curve, right? From left to right, right? That explain. That's very at higher prices, lower demand, lower prices, higher quantity demand. So that is based on the indifference curve analysis. Right? Yeah, that is this. That's based on the indifference curve analysis. Right. Okay. So then I have now just sketch this ICC and the BCC, right? So say something about this ICC means what? Some consumption curve. Right? Now we identified the budget line change, right? You change with the income, right? One thing. If the income change, entire budget line shift to the right or left. There's rising income, entire budget line shift to the right. Right. So when the budget line increase and the money income increase, so we can buy more from two bundles, no? Right? From both axes. Right? Consumer purchasing power increase. Right? We can go for higher level of satisfaction by receiving higher level of convenience from both goods. Right? So that shift the budget line, right? When the income increases, goes and also the utility also increase. You see, go to the higher level of combination. So that shift the indifference curve also with respect to change in income. So by combining these equilibrium points, right? So we can draw the income consumption. Because this change the entire income, right? And based on that, equilibrium also change from E1, E2, E3, E4, like that, right? So by combining those points, we go to the that is called income consumption, right? So by now you see here the income increase from M1, M2, M3, M4, like that, and our money income increase. And that will, that's why this budget line shift, no, right? No, sorry. So the budget line shift, right? You rising the income, right? But here it means something like this, right? The base combination, right? From the product base. Income means combination of the product. Why? The money income increase, right? So that should be the entire equilibrium also change, right? Since the possibility to switch to the higher level of satisfaction by pursuing higher level of combinations. So that it gives the higher difference flow, right? We are reaching the higher difference flow. So the equilibrium also changes. So then combining those points, we go the income consumption. Now here the same like earlier, like price thing is right. So we assume price of the product X change, no? Right? So if there is a decline in the price of the product X, so entire budget line rotate from the X axis, right? So that will also allow the consumer to go to the higher level of satisfaction. It seems there's a possibility of consumer to consume more from product X. So that's the indifference curve as well, right? So we will get the bottom line of the right and each level of prices, right? Decline the prices. Right? So the combining these points, as we discussed here, we will price consumption. That is for price consumption code replacement. Okay. Now this the slope of this curve is very important, right? When we explain, right? So income change and the ICC upward slope, right? Something is normal good. We can classify the goods, right? With respect to income change, if there is a this is something downward sloping, maybe the inferior would go something. Based on that, we can analyze the situation. Same thing, the price consumption curve also now we know that different case, right? Price index is more powerful, right? So that also we can analyze. So we will talk about that one next day, right? If we will on that, right? So since like the midnight, I mentioned this, I was everything all the regions and we will care versions. Then I enjoy it. So we will like this. But other things, some of the things behind this ICC and this ICC, next day we will discuss and we will profit. Right. So that's about today's. So if you have any question, you can ask. Am I going fast? We have something like that. Okay, right. So you need to refer some other things right? So we need to refer the textbooks, right? So explain these things, right? We will get more understanding. There is no technical. And they additional items, right? Regarding those steps, right? So maybe so right. You need to go to the terms and explain. Must be familiar with these terms. From the beginning to end, how it is made, right? How it is changed, you must be familiar. Once you look at this graph, you can't say anything, right? You need to start your discussion from the first slide, right? Assuming the things price changes and so on, right? You need to calculate your story. You have to please refer the additional textbooks, right? If you have any question, you can ask next day, right? So for the time being, we will find out the system. We have more questions. Okay. Any questions? No, we are not talking, right? Okay, we will stop because you are hungry, right? And we go to the next session also, right? Okay, thank you very much.